Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Big day coming up today. Chairman Powell a little bit later. Job openings data coming up a little bit later this morning as well. Going into all of that, your equity market's shaping up as follows. On the S&P 500, futures elevated just about, up by 0.1% on the Nasdaq, up by 0.25%. In the bond market for the month so far, 10-year yields lower, much, much lower, driving a deeper inversion of the yield curve. And you see a little bit more of that this morning. We're down a basis point on a 10-year to 373. On a 2-year, unchanged at 447.31. In the FX market, this is where the move has been in November. A monster move in the euro. Month to date, euro dollar is positive 4.8%. That would be the biggest monthly move, Tom.
Off a lot of gloom.
Off a lot of gloom, I agree with you.
A lot of gloom.
We're very close to the biggest monthly move since 2010. Very close to it.
I think misreported today, John, within all this market jumble is inflation. There's some headlines out, folks, as you wake up in America that inflation's maybe fractionally better in Europe. John, explain 12.4% food inflation in the United Kingdom. You got to be kidding me.
Things are easing headline, but if you look at core in Europe, there's still a problem.
Yeah.
And I think core of Europe in at around 5% is going to mean another rate hike at the ECB on December 15th. Whether it's 50 or 75, we won't get into that debate right now, but they've got a problem, Tom, and we know what the problem is. It's not just inflation, it's growth rolling over.
Yeah, I'll go with the stagflation bit on steroids in the United Kingdom as well, but double digit. Politicians behave differently. We don't have that in America.
No, we don't.
It's all there is to it. Let's do this, folks. Let's go to someone that can piece together your November and try to stagger into 2023. They do that at Deutsche Bank, led by David Folkers-Landau, and he has as his chief international strategist, Alan Ruskin, who has been such a supporter of the show through this crazy year. Alan, I want to go a little bit technical right now. The Bloomberg Financial Conditions Index, which I think the great Michael Rosenberg told me is 11 ratios. The fact is, over November, it has become more accommodative. On a standard deviation basis, we've moved from the gloom of a -1 standard deviation almost back to -0.50 standard deviation. We are more accommodative. How does that change Chairman Powell's speech today and the Fed meeting forward?
Yeah, Tom, I think it's a great question, really, because I think on the one hand, Chairman Powell will just look to what the Fed Fund futures are pricing in, and it's looking for a peak in Fed funds of around 5%. I think that would seem pretty reasonable to him. Then you look at really what's happened since the last FOMC meeting, and as you remark, every major component of the Financial Conditions Index has eased substantially. Obviously, the bond market, particularly, I think, has been driving things. Some of this is very much related to CPI, but you've also got tangential markets, things like the oil price, which has come down very sharply. I think around the FOMC, it was tracking around $90 a barrel, and then WTI, it's now $80 a barrel. It's just everything is pointing in a more constructive way. I don't think that's a terrible thing from his standpoint. I think it's something you'd want to monitor.
Right.
But I think it takes away, to some extent, the fears of a particularly sharp slowdown in growth.
I thought Draghi was so good on this at the ECB, the economist from MIT, and Alan, you are as well. In your research note, you spend a lot of time on the when. The way we frame this, folks, our listeners and viewers, is the x-axis. Think about that chart you made in school. Alan Ruskin, what matters on the x-axis right now as you go out into next year and indeed into 2024? Where is the when that you're focused on?
Yeah, well, I think, people ask questions on the when related to when will we have a recession. And the main recession indicator that people have been looking at, of course, we all focused on, is the yield curve. And that's suggestive of a recession. Normally it leads by roughly about 18 months to 2 years, so a long lead time. And that would suggest pretty much the second half of 2023 is the when on that particular question.
Yeah.
When you look at other leading indicators, of course, you're seeing something which is on a path towards a recession, but it is not saying a recession's baked in the cake. The one point of, that I would say, Tom, that I'd emphasize is we are all looking at the same thing. And the yield curve could give some misleading signals given the supply side shock. And it's a favorable supply side shock that we're currently under at the moment.
Right.
Yeah, that could certainly lead to more flattening of the yield curve than you would otherwise think. And I don't think it's quite as recessionary or as strong a recession signal as it would otherwise be.
Lisa, can we have a victory lap for Matthew Lazzetti, a colleague of Mr. Ruskin? He nailed the recession call, but also the when of it in hindsight, out farther. Remember, we were giving him grief because he was talking end of 2023, whatever. I mean, Lazzetti nailed it so far.
And a lot of people are on board with that. The question that I'm wondering, though, exactly to your point, Alan, is the supply side issues, which we really don't understand in terms of whether they come back online, whether you get those production delays that are eradicated, especially with COVID-0. What's your base case in terms of supply chain disruptions and lack of supplies, and whether that eases enough next year to really reduce some of the inflationary pressure?
I think it's eased enormously, really. I think if you look at supply deliveries in particular, in most indicators, they've actually, normalized or pretty much got back into the range that we saw pre-COVID. When you look at PMI prices paid, those numbers are typically also within the zone of what we saw pre-COVID as well. So I think there's reasons for optimism on the supply side. I think, like everybody, the biggest concern is that inflation's been around for long enough that it's become entrenched in the labor market. And, that's, I think, where the residual inflation pressures still reside. And that's really, which is it's really going to create angst amongst the Fed. If we see employment cost index not come down, other wage indicators like hourly earnings not come down.
Which is the reason why a lot of people are watching JOLTS today, and on Friday, the jobs report. People are also watching the housing market reports to get some sort of sense with respect to your core, which is FX, where you started. And I'm wondering, Vasilios Giannakis yesterday of Citi saying that the housing market may be the biggest distinguishing feature between the winners and the losers internationally. The ones that have the worst housing markets might end up suffering the biggest weakening in their currencies. Do you buy that? Do you see that as a correct roadmap?
I think it is an important roadmap, and in most cycles it tends to be dominant. I would say here in the US, at least, the concerns on housing are probably a little exaggerated. Starts is housing starts one of the best indicators, permits one of the best indicators. But I think you can have house price deflation come off quite substantially without it being too problematic for consumption, in part because house inflation was so strong to begin with. I think on an international side, the countries I would worry about most, and my colleagues in London have pointed this out, is Sweden and Canada. Those are the countries where the debt to relative to disposable income is most problematic. The financing issues are most problematic. So I think you have to watch Canada, the Canadian dollar, and the stocky, really. Those are the vulnerable currencies.
Alan, I got to go out buying Christmas tree to keep up with the Farrow family. I mean, Farrow had his tree up way before Thanksgiving. I'm going out today on demand of afterthought, and I need to make an FX trade here. Dollar up 14% off the bottom. Can you stay resilient, strong dollar this year, and what's the best way to play it?
Yeah, look, I think the dollar has almost certainly peaked. You don't get these sizable moves without usually some sort of follow through. But I think we're going to have a bit of a bumpy year, as it were, because, the Fed is obviously still tightening. We still got to get to at least a 5% funds rate. If there are risks in terms of the funds rate, it's probably still to the top side rather than to the downside. So, that's going to sort of bolster the dollar's case. I think over time, we're just building effectively a base on euro dollar, between parity and say 105 for an eventual assault on sort of 110, later in the year.
Alan,
That's
wonderful to
sort of
hear from you,
later
sir.
in 2023, that is, yeah?
Alan Ruskin at Deutsche Bank. Alan, thank you. COVID ruined my Christmas tree plans, Tom. They got delayed because of COVID. And then eventually I put the tree up the day before Thanksgiving.
I had COVID
when I had the
12 months
energy
ago.
to
It
do
really
that.
gets, yeah, it really gets.
I like how I get
you doing
COVID and you
okay?
go around saying that I'm on assignment at the World Cup.
Well, you know, you made it to Dubai. You didn't get all the way to Qatar.
Just got this post-COVID congestion, Tom. Can't clear it out of my voice.
Everyone has it. I'm sure everybody's got their own anecdote, including Lisa. But the one I live by is Amory Horton, who used to run from the office in London out to Windsor and back every day after work.
I'm not sure she ran to Windsor.
Well, that's what she said. And she had to stop doing it when she
Used
got
to run to
COVID
West
years ago.
London. Used to run to West London.
Well, Windsor's
You know,
just
like
after
Westminster
Harrods, right?
up to...
You go to Harrods and...
No,
you know,
Windsor's...
I didn't know that.
Anyway, Chairman Powell coming up a little bit later.
Really
we'll
good
move
pivot.
on. Yeah, we'll move on. Hard pivot. 1:30 Eastern Time. We know that this chairman wants to de-emphasize the pace as they shift from 75 to 50 and re-emphasize the destination, Tom, and that's higher than they previously thought. The power of a central banker, whenever they speak, is always about emphasis. And I wonder whether he leans in against what we've seen so far this month in financial conditions, Tom, as they continue to ease.
They're going away from him and all the other pundits, but I'm going to say this, and it's Greenspanian, when the chairman speaks, it's different than even Vice Chairman Brainerd or the other presidents.
Couldn't agree more,
it's
TK.
A whole I mean, this is, folks, even if you're not engaged in this, you lean forward when the chairman speaks.
They're talking up going longer and higher. I hear all of that. The question is, Lisa, whether the market is responding to that Fed speaking quite the same way over the last couple of weeks, and a lot of people would argue it's not.
If the market doesn't respond to Jay Powell when he reiterates the exact same message that he did last time, the exact same message that all of his peers have been messaging over the past couple of weeks, if the market doesn't respond, does this become a credibility issue for the Federal Reserve, who isn't able to have the forward thought to be able to say, we won't have to cut rates next year. Listen to us. You're wrong. We're right. Don't fight the Fed. That's an issue.
It's the data, Tom.
Yeah, well, it's the data.
CPI December 13th.
I'm going to be focused on Powell after North Macedonia.
Why are you bringing up North Macedonia?
I mean, I'm looking forward to it.
Are you trying to troll Italy again?
I'm trolling. Italy, I miss.
That's
Everybody
unfair,
misses.
TK.
Alan Ruskin said he misses Italy. You know,
I miss Italy.
You know.
Future's up.
Tunisia. Good morning, Tunisia.
By 10
Look
to
at
1%.
Ghana winning.
Good game that was.
That was a good game. It's a match. We call that a match.
You call that a match?
Yes, I learned that from you.
Okay. You was down a basis point. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Washington, the leader of the right-wing Oath Keepers group, Stuart Rhodes, has been convicted of seditious conspiracy for his role in the storming of the U.S. Capitol in 2021. One other defendant was convicted of the same charge. It's the first trial of the most serious charge from the riot. This month, prices in UK shops rose at their highest rate since at least 2005. The British Retail Consortium said shop price inflation accelerated to 7.4% in November. Food prices were more than 12% higher, with meat, eggs, dairy, and coffee leading the way. China is sending a warning to protesters angry about COVID restrictions. The country's top law enforcement body promised to crack down on what it calls hostile forces and their sabotage. The timing of those remarks suggests they came in response to last weekend's rare demonstrations. Boeing could have the green light to certify its final two 737 MAX models without an expensive redesign. U.S. lawmakers are nearing a compromise that would allow the MAX 7 and MAX 10 to move forward before a late December certification deadline, while also requiring an additional sensor system. Now, that proposal hasn't been finalized and is opposed by some lawmakers and family members of passengers who died in crashes of the two models in 2018 and 2019. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
genomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
Fed's going to have to raise rates at least a couple times more. Look for 5% top, something like that. And then they're going to hold there for a while because it's going to take a long time for these rate increases to feed through to reduce those inflation pressures.
That was Joanne Feeney of Advisors Capital, live from New York City this morning. Good morning to you. Chairman Powell, 1:30 Eastern Time coming up. Looking forward to hearing from the Fed Chair a little bit later. Before we get there, some economic data as well. Job openings in America a little bit later this morning. Going into all of that, your equity market's shaping up as follows on the S&P 500. Slightly positive, up by 0.2%. Yield slightly lower by a basis point or two, 372.73. Closing out November with euro-dollar at 103.65. Closing out November with euro-dollar up by more than 4%. In the month of November, Tom. Some real dollar weakness this month.
And Alan Ruskin calling for this is it for dollar strength as well. There's no question that's been the big shift of the year, and big figures have been made there. Some people making money, I'm sure some losing as well. John, I wonder what it means for EM. I think it's been underplayed this year, the disappointment of international so correlated. They need a weak dollar to make it work.
You tell me what's going to happen with China. Maybe I can give you a better call on EM. Just getting a headline across the Bloomberg on State Street. State Street to terminate the deal to buy Brown Brothers Harriman, Tom. Going on to say that the deal doesn't provide for contractual penalty. They're terminating the deal because it's not in the interest of clients to continue.
Right.
That headline just crossed in moments ago.
The backdrop here is so important, and that Alliance Bernstein took Bernstein Research and paired it off the other day in a joint venture, and people are trying to figure out how to cut expenses, how to be more focused, given the collapse of active management. This is a huge backdrop. I've been remiss, John, in not studying once again this year index funds, the flows. Unbelievable.
I should stress here, Tom, there's also a headline that stresses that it was a mutual agreement to end this deal, Lisa. That headline just crossed in moments ago.
To get some details on this, we're not sure, right? But the path forward would involve further delays. That's what State Street was indicating. Perhaps it was more complicated to understand, especially as we head into a period of such uncertainty where we don't even know what China's going to do.
Hey, I mean, Tom, maximum uncertainty into 23, I think is probably the headline.
And around Societe Generale Bernstein, it's the same thing. People are making it up as they go. And again, this is the challenges of how the intellectual content of the street moves forward into 2023. We're going to look at the I'll get 3, 2, 1.
Cue.
We're going to look at the intellectual content of the railroad strike. We do this with Leslie Venjamuri, head of U.S. and America's program at Chatham House, and once she played Monopoly and owned all 4 railroads. We think she's qualified there. What is the distinction of this rail strike? I hearken back to all the history of my childhood. Why is this like the past, or why is this, Leslie, different from the past strikes?
Well, I think maybe one reason it's different is because we have, a president in office who has just come off the back of a, very big success in the midterm elections by historical standards. And, the Democratic Party used to be the party of the unions. And what we're seeing now is a president who looks set to take a very hard decision, which is to push to have those strikes blocked because of the sheer price that they will cost the U.S. economy if they go forward. This is, and this is a defining moment, as you know, Tom, because this is a president who's going to have to really, in effect, push it back against a group of Americans that Donald Trump courted, that the Republicans have sort of taken over, that we've seen some Democrats try to bring back in those voters, those working class voters. And this really will open up, the Democratic Party for attack from union workers, from Republicans that will spin this, and from workers who will be very dissatisfied that they don't have paid sick leave and other benefits that they think are very, very important.
The backdrop of this, Leslie, is inflation and just how high it is, and that is the preeminent concern not only of monetary policymakers, but also of politicians around the world. How much is the U.S.'s effort to reduce inflation with some of the recent legislation creating tensions that are irreconcilable with Europe, which we continue to hear about today in Brussels?
A really good question. There are all sorts of conflicting pressures on this relationship between the United States and Europe. And certainly inflation is one of them. There's a real concern about that. There's also some real competition concerns that Europe has about the subsidies that the Inflation Reduction Act is giving to the energy sector, to hydrogen, to the climate energy sector. To semiconductor chips. There's all sorts of headline tensions, and yet there is that overriding desire to stay on the same page when it comes to Ukraine, when it comes to China. We're seeing Biden push hard on Europe to take a unified position alongside the United States. And we're also seeing phenomenal courting of Europe, and we're going to see that, over the next few days as President Biden welcomes the French president for that first state visit.
Leslie, the history of strikes here is the Great Strike of 1877 and on to after World War II, where America woke up to labor unrest in 1946, and here we are. Compare where America is now with the future of strikes as compared to what we see in Europe. I've been taught atomization is what we've seen in our labor force. Is that true, or are we going to see more strikes?
Well, this does look like something from the past. It is quite extraordinary. It's sophisticated, but we also are seeing a president who's going to push back. And the question will be, then what? What is the next move? It does, I think, stand in deep contrast to what we're seeing here in the United Kingdom, where we're facing ongoing strikes and have been facing strikes in the university sector, in the transportation sector, that don't look like they will end anytime soon. And the government in the United States is taking a very different, much harder line on this. So I don't think that we will see a return. This is not back to the future in the United States, I don't think.
Leslie, wonderful to get your perspective as always. Leslie Venjamuri there of Chatham House. Tom, Labour has leverage in a way that it hasn't had leverage in a long time. Now, we can argue how much that leverage has perhaps been eroded over the last 6-9 months or so, but still, relative to the last 10 years, there is leverage that exists there that did not exist.
My amateur take is we underestimate the power of labor after 13 years, I'm going to, plus or minus a couple years here, of management, power, management, strength. At least public unions, fine, I get that. But what about Detroit? What about other unions? I just think as a nation, we underplay the power of labor as we're seeing right this morning.
Which labor? That's what I would ask, because right now it seems like the power of labor lies with the real economy, and suddenly the real economy matters so much more than tech, than some of the corporate office jobs, and that to me is a takeaway from the past 10 months.
Where Powell speaks today at Brookings, they've done definitive research on the quintiles and deciles of American labor, and the power of the lower decile, the lower quintile, is we need them so their wages have come up, maybe in a non-labor, non-strike way.
The leverage of news anchors. Just the power.
It's just speechless. I did a panel on that at Davos a couple
Did you?
years
I
ago.
bet that was really well attended.
It was well attended. I was speaking against president of somebody. I think 4 people showed up.
Mano Mahajan's coming up.
It was at
from
the
Edward
espresso
Jones.
bar.
Up next from New York, this is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist. And I think we are witnessing right now a societal change in the way we work. You're no longer going to measure productivity in the same way as in the past. You're going to be focusing on output. Never mind what people do in their private times. It doesn't really matter to a company as long as the output is there.
HPE launched its Edge to Office hybrid work initiative in the fall of 2020. The new campus is designed with that flexible model in mind.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution
coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Inflation is going to take a longer time to corral than people think.
Really, what's happened is transitory never went away.
The services inflation is not rolling over, and the sticky services inflation is not rolling over.
The tightness of the labor market can continue, and that's going to keep the Fed on edge.
Markets clearly are deciding that there are risks, elevated risks toward recession next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Counting down to Chairman Powell, live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures right now up 0.2% on the S&P 500. TK a little bit later this morning. Job openings in America, then it's on to Chairman Powell this afternoon.
Not another week before the holidays. We're making jokes about Christmas trees and all that, John. This is serious. This is a busy, busy week. Tons of data to say. I mean, you mentioned ISM as well, to stagger to Friday on a jobs report. I'm surprised, John, we're at a 200,000 statistic on non-farm payrolls with the job gloom that we're living.
That's the estimate, 200K in our survey for Friday, 261,000, the previous number. Lisa asked the question at the start of the week, and I think it's the important question to be asking. Lisa, what's more important, the data or the Fed speak this week?
The data, hands down. I think everyone pretty much agrees because the Fed's been speaking and the market's not listening. They're watching the data, and that is going to continue to be in the forefront because one data print doesn't necessarily change the view of a Federal Reserve, but one weaker inflation print plus one looser than expected labor market report, you add them together and suddenly you get something different.
Well, inflation easing in the Eurozone, Tom. A drop, but still double-digit CPI headline.
I take huge issue with this.
We're on the same page about this, Tom. You get an easing of inflation, yes, but at the same time, it's incredibly elevated.
Yeah, it's incredibly elevated. I got an offspring in Paris right now. Her electric bill went up $40, you know. I said, well, cut out the baguettes and let's go.
Are you paying for it?
Of course I'm paying for it. But the bottom line is everybody's got their microstory in America and certainly living it in Europe. This is serious stuff. And the major story in December, John, is Europe doesn't have the economic statistics of America or even a resilient Great Britain.
So what explains the massive month we've just had for the euro dollar? Up by about 4% this month.
I think we're shifting to this pivot thing, which I hate. I can't believe I'm saying.
Well, you said it. It came out your mouth.
I mean, he's not going to say pivot today, is he?
Take a look at the natural gas prices in Europe. How much does that just directly track to what we've seen in the euro? It's better than expected data coming out of how warm the winter is going to be, as well as the stockpiles of natural gas. You add that together, it's not the worst case scenario, and so all of a sudden you get massive dollar weakness and incredible euro rally. Is it sustainable is another question.
Euro stronger on the session on the month as well. Your equity market looks a little something like this on the S&P 500, positive by 0.2%, going into the opening bell about 2 hours and 30 minutes away. Yields a little bit lower here, Tom, down 2 basis points at 3.72 on a 10-year. Certainly the story of the month in the bond market, Tom, has just been the deep curve inversion we've seen in treasuries.
It is. We got out to 80 basis points. We've come back a little bit in all that, but I'm going to sum it up, John, into end of the month, into December. We mentioned this with Alan Ruskin. The 11 ratio, I believe it is, Bloomberg Financial Conditions Index, has gone against Chairman Powell. He wants a more restrictive environment, and he doesn't have that with moving from a -1 standard deviation out to a more accommodative -0.5 standard deviation. Forget the mumbo jumbo. All you need to know is Powell's not happy.
Lisa, will he push back a little bit later?
We'll find out. The warm-up act is Fed Speak that includes Fed Governors Michelle Bowman and Lisa Cook. Then the main act, Jerome Powell, 1:30 p.m. at Brookings. Does he push back? Does he also have any power over markets? I'm more interested almost in how the market responds to what he says than what he says. Is there still the credibility and the weight behind his words? We also hear today from Treasury Secretary Janet Yellen, Amazon CEO Andy Jassy, and perhaps more importantly, FTX founder and CEO Sam Bankman-Fried. He has been very quiet since his company went bankrupt, FTX. Where did the $8 billion go? How did he come up with some sort of shortfall? Some of these questions will be answered. Controversial that he is on this stage. For some people pushing back and saying still very many questions around the nature of some of the disappearance of certain funds. And today we get a host of data. JOLTS in particular, the job openings. That's what I'm watching at 10 a.m. Do we see an ongoing decline in the number of openings? Are companies saying we're not going to hire so much, or do we see an increase? Do we see an ongoing need for workers in certain sectors, even as you see big tech continue to push back? And at 2 p.m., John, I'll be reading the beige book, and you'll be watching.
Do we have any weak data now? Do we have any weak labor data? Is there anything besides the tech blow-ups and all that?
If you look at the breakdown of the data on the Bloomberg, the labour market data is surprised to the upside.
Yeah.
That's where the positive surprises have come from, if you look at the economic data. Relative to expectations.
I don't know what he says today. He's not going to talk about labor, and he's not going to talk about pivot. What's he going to talk about?
I wonder if he repeats what he said in the news conference.
Yes.
Leans into the destination and tries to push back against the easing of financial conditions. We'll talk about the journey and your feelings a little bit later. Mona Mahajan joins us now, Senior Investment Strategist at Edward Jones. Mona, I have to say, reading through your work, you sound a little bit more constructive going into 2023. Where does that constructive view come from?
Yeah, thanks, Sean. Look, I think we have a journey to get to that constructive view, but I certainly the Fed is still on this path to raise rates. They've made it clear they are not done. And in fact, we're probably heading towards that 5% level early in 2023. And of course, the focus is shifting somewhat in markets from this inflationary ongoing upward pressure to perhaps some stabilization, but then of course a shift towards what happens to the economic growth picture, which we think does soften, especially in that first half of 2023. But perhaps a silver lining and that more constructive view comes from the fact that we are perhaps set up then, the stage is then set for a potential recovery from a market perspective. And keep in mind, the market cycle and economic cycle are two different animals. And in fact, markets can head towards a low, make a low, but then rebound even as we are in perhaps a downturn or recession. And so I think that's where the constructive view comes from. And of course, the hope and the leading indicators of inflation that are showing that stability ahead.
Mona, in the next year, would you explain Surveillance 101 that the world doesn't end if we get a 5% terminal rate? We've been there before. Why are we so angst-ridden this time?
Yeah, a great point. In fact, if you look at, a 30-year history, a 5% Fed funds rate is not out of the norm, and a Treasury yield certainly at 3.5% to 4% is not out of the norm. What we will say is unique this time around versus the last 10 years, perhaps the period after the great financial crisis. That's when the Fed was perhaps closer to the zero bound, Treasury yields closer to 2%. That whole period was really marked by a growth outperformance, growth versus value. This period ahead is unique in the fact that we probably won't head back to the zero bound. The Fed can go from about a 5% rate over time, perhaps back to a more neutral rate, 2.5% range, let's say. But yields, Treasury yields in that environment may also remain in that 2 to 3.5% range. And so what's different, I think, is that you do have an alternative to equities in play, probably a better mix between bonds and stocks in your portfolio, but also that environment where growth outperformed for perhaps close to a decade. It may look a little different in the next decade ahead in that because yields are higher, we could get a better balance between growth and value as well.
What if Evan Brown of UBS is right and we avoid a recession next year? And that ends up being really negative in terms of creating higher rates for longer that bleeds into an over-indebted society, which a lot of people say is the case. How does that factor into your outlook?
Yeah, it's interesting. We don't necessarily think the path to a soft landing is completely closed either, but we do think it's getting narrower. And a lot of the leading indicators that we watch, including the curve, but also things like the PMIs and ISM indicators are pointing towards, if not recession, at least a softening below trend. So we do think that is in the cards. But if we do avoid that recessionary path and hit the soft landing, we do think actually markets will respond favorably to that to some extent. I think the jobs picture will be in decent condition. We'll have a consumer in healthy shape. And in fact, you could get through this period. We think the inflationary pressures were largely supply side driven, and the demand picture will soften. And so we think inflation could come in as well. And so we don't think it's necessarily this dire scenario to avoid a recession here in the US. But keep in mind, recessionary cycles are part of the business cycle. And so we do think at some point the excesses that have accumulated over the past 2 to 3 years, that will play itself out to some extent, and perhaps We won't see a broader recession, but we could see what we're calling that rolling recession in certain sectors, and perhaps are starting to see that in the tech sector, which was probably where a lot of the excesses happened during that pandemic period. But I think to your broader point, with debt increasing and yields moving higher and perhaps staying higher, we will see a little bit of a clearing impact on the credit side as well, but probably a good thing for investors who are looking for value.
So, Manuel, I just want to squeeze this in 20 seconds. Can you be super specific where you think the leadership is going to come from?
Yeah, we think heading into the year, we could still see this defensive value play have a little bit of legs because we are entering a period of potential downward momentum in the economy. But as we reemerge from that, we think the recovery playbook is back in play. Areas, parts of quality growth will probably take some leadership, but cyclicals and maybe even that small cap sector will return as well. So think about more balance in your portfolio heading into 2023.
Mona, thank you. As always,
She was
wonderful.
too optimistic for
Mona
some
Mahajan
reasons.
of Edward Jones, the
Just
constructive
too
view.
much.
That was the constructive view on 23.
Yes, like we gotta do a shout out to these people that are resilient, didn't see the world coming to, and people like Binky Chadha at Deutsche Bank and Mona. I mean, they're framing out a more optimistic year coming off of where we are.
I think he was framing out 47.50, Tom, on the S&P.
Oh, okay. I'm going to give him, Stoltzfus. No, but I'm going to give him some slack on the timeline. Maybe it's June of next year, but I'm sorry.
Tom,
the gloom didn't
come on.
occur.
That's not a call. You give us some slack on the timeline. You're going to push that view out 12 months, 18 months, and then say they were right.
6 months. I'll push it out 6 months. Where's the holiday spirit?
What, you want me to be kinder?
I want you to be kinder.
I'm kind about calls all the
Come
time.
on, we had the June rally, and then granted it was terrible.
Is
and
that
now
me
we
saying
have
that
this
Euro
rally.
dollar 120? I'm just not going to tell you when.
Yeah.
And then when it hits
Welcome to
120,
Wall Street.
S&P 5,000.
You better thank me.
Welcome
At
to
some
Wall
point.
Street.
At some point
out
in the
there.
future. Not sure when. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Inflation in the Eurozone has slowed down for the first time in 1.5 years. The reading for November was 10%, less than the median estimate. That offers a glimmer of hope to the European Central Bank and its struggle to curb the worst inflation and consumer price shock in a generation. Federal Reserve Chairman Jerome Powell may cement expectations for a slower pace of interest rate hikes in the U.S. today. Powell speaks at an event in Washington. He may echo former Fed officials in signaling a half-point rise at their final meeting of the year. France's President Emmanuel Macron is now in the U.S. for the first White House state visit in more than 3 years. Thursday's dinner, hosted by President Biden, will celebrate the oldest U.S. alliance. It will be preceded by meetings with the U.S. lawmakers and at NASA. Still, Macron is unhappy with the U.S. over several trade and defense issues. The U.S. Senate has passed a bill that enshrines federal protection for same-sex marriages. The vote was 61-36, with 12 Republicans joining the Democratic majority. Democrats had raised concerns that the Supreme Court could overturn a ruling that established the right to same-sex marriage. That measure now goes to the House, where final passage is expected. And former Chinese President Jiang Zemin has died. Jiang presided over more than a decade of dramatic economic growth following the bloody 1989 crackdown on pro-democracy demonstrations in Tiananmen Square. China's economy more than tripled in size in the 13 years Jiang was in power. At the same time, though, he resisted political reform. Jiang Zemin was 96. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Friday, all eyes are on the jobs report.
Jobs report Friday is going to be huge.
It's the final stretch of 2022.
Is there actually going to be some change in the tone?
Wage data might be more important than the CPI.
This Friday, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is stronger than people have thought it would be.
The recession is not here yet, but the check is certainly in the mail.
We're going into a downturn at full employment.
The November Jobs Report, Friday on Bloomberg Television and Radio.
I don't like going against the ability of unions to strike, but weighing the equities, we must avoid a strike. Jobs will be lost, even union jobs will be lost, water will not be safe, product will not be going to market. It is, we could lose 750,000 jobs, some of them union jobs. That must be avoided.
Speaker Pelosi on the main event in Washington, D.C. at the moment. We'll get back to that main event in just a moment. Tom, just getting confirmation we will be catching up with Secretary Walsh this Friday after payrolls, 9:45
Good.
Eastern Time.
Really interesting to see what he says about the strike, because he's lived as mayor of Boston and with his union heritage from another time and place of Dorchester and South Boston.
Precisely.
This guy is qualified to speak of does it extend beyond us. Pelosi there sounded just like Harry Truman, 1946.
You remember it?
Verbatim. I don't remember it, wise guy. I do not remember. I had to go read Nevins on Truman.
Go on. You teed that up. You teed that up.
Let's tee it up right
so
now.
Easy.
You know, we were doing this with Futures of 7. Dow Futures up 21 this morning. John, Macron's coming. He's here. He's in Washington.
I think there's some real tension in
Talk to
Tom.
Emery. But Could you imagine President Biden saying somebody on the U.S. soccer team, you got to stay at Arsenal or whatever? The president of France is telling Mbappe, this guy that I think is great for France, he's got to stay at PSG versus Real Madrid.
That classic French nationalism, Tom.
Yeah, I mean, come on. I mean, that stuff matters, doesn't it?
Of course it does. I think there's a bit of tension here between the president and the French leader.
Oh, yeah.
I think there really is with the Europeans around trade.
Let's get a brief on this now. We do this with Anne-Marie Horton, who's lived it as well. Mr. Macron will attend Washington. It is a special relationship. It's fractured, Anne-Marie. Have they moved beyond the Australian submarine debacle?
Well, it was this time last year, right, that this was really something that was a huge deal in the relationship, was really fraying the relationship. You saw Macron call back the ambassador in Washington to France because they were so irked by this and the communication that they feel like the United States did not bring them in on this when they struck this deal with Australia and the United Kingdom, and this really was a blow for France. They moved beyond that, but there's a new issue in this special relationship, and that has to go with Jonathan was just talking about, which is trade. Macron has called it unfriendly policies about the Inflation Reduction Act and the subsidies this would be for U.S. companies, and his finance minister, Bruno Le Maire, went even further, equating it to what China does. So this is clearly going to be brought up, even though there's going to be a lot of pomp and circumstance and all the exciting stuff of a state dinner. There's real tension at the heart of this relationship.
But come on, Anne-Marie, from de Gaulle to Pompidou and beyond to Chirac, they invented state intervention in industry. Aren't we just ripping out a page from what the French did 30 years ago?
And you know what? The French and the Europeans may end up doing this themselves. And, you know, what this administration likes to talk about is the fact that there's not enough investment in clean energy, in EV anyway. So this is why they are doing this, and they really don't think there's going to be harm to these European companies. So, you know, it'll be interesting what happens. There's some task force that the Europeans and the U.S. are working on to how they get out of this, because this is something that behind closed doors and even out in open, European officials are incredibly annoyed about with the Biden administration. But also, we should note that there is a divergence in Europe about this. You have the Germans at the same time who, especially the likes of Habeck, who's the German economy minister, he comes from the Green Party. He thinks things like this are actually useful in the industry, and they also want to make sure that the lines of communication are open and friendly with the Biden administration.
And just sort of to dig into that a little bit more, Anne-Marie, what does Emmanuel Macron want from President Biden in order to feel more okay with the plans as they are now?
Well, he probably wants them to rip up the IRA, right? But Congress passed legislation, now it's law, so that's not going to be happening. So there's really not an end game for this unless Congress was to go back and adopt a new law. That's not happening. So this might just be the U.S. trying to make the French feel good.
Okay, so how important is it for the U.S. to make the French feel good when they're trying to get some unity around, particularly China? Sort of ironic, given some of the jawboning recently.
Well, also ironic, given Charles Michel is en route to China at this moment. He'll be landing there this week. Particularly difficult timing, given the fact that there are protests around the country due to their COVID-0 policy. And also, Emmanuel Macron will be heading to China. I mean, I think what the U.S. is likely going to convey to Macron, as they have with other European leaders, is the fact that the West needs to remain united when it comes to China. The U.S. has struck a number of not just legislation when it comes to producing more chips at home, but also curbing exports to China. This has drawn the ear of other Europeans, like the Netherlands, who send a lot of high technology chips to China. But the U.S. is really trying to go for this multilateral approach to make sure that when they're setting up competition with China, it's not just the U.S. versus China, it's the U.S. alongside their allies.
MH, thank you. Down in Washington, Anne-Marie on the latest with a meeting between the president and the French leader. Sure, far away.
6.2 million tourists from America visit Paris, as compared to the United Kingdom, 2.7 million.
Where are we going with this?
Do you really want to know where we're going with this?
I'm trying to work it out.
I could
Where do you think we're
explain.
going with this?
Well, Tom thinks Paris. He thinks Emmanuel Macron. He thinks vacation.
Oh,
he thinks
Tom's
of
Tom's
right
planning.
and going to Paris, right?
No, what's important here is in the Bloomberg world, folks, we are centered on London, New York, and Hong Kong. And London is the city-state of finance there. France has given up the financial, and good morning, BNP Paribas and SocGen. I'm sorry to insult you. Mon Dieu. But the bottom line here, but no, c'est bon.
That's it.
Yeah, that's it.
We read baguette.
Baguette. Okay, there we go. Thank you. John, what's important here is, could you imagine Paris if they decided to become capitalistic and compete with London?
They need more flexible labor laws.
Yes.
A job in Paris at a bank is viewed by the people that run the bank as a job for life, and they like the flexibility of the laws in London and in New York.
Yeah, I just think that we're biased against covering London and New York versus Paris. And
I do think the French talking about protectionism and throwing that accusation around comes across a little bit rich. Do you remember when Pepsi wanted to buy Danone all that time ago? Do you remember that?
Right,
yes. I think the French described it as a flower of industry, and they didn't want to let it go.
In England, do you say Renault or Renault?
I say Renault. What do you say?
From my childhood, we say Renault, which I think is like fossil.
Mission critical when I was going through the show plan this morning.
Yeah. Well, it's good. You know, Renault
and the producers told me that this is something Tom might want to about.
What show plan?
Exactly. Should probably do one of those one day.
Let's all watch Charade.
Let's try.
Futures
Audrey
up
Hepburn, Cary
2/10
Grant, Charade
on the S&P. Mon Dieu.
Mon Dieu.
I'm sure the French are incredibly offended this morning. My apologies.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Around about 2 hours away from the opening bell, equity futures elevated and slightly positive on the S&P 500, up by a couple of tenths of 1%. On the S&P, on the Nasdaq, up 0.4%, up on a session on the day, up on the month as well. In the bond market, yields down on the month on a 10-year Treasury by around about 30 basis points. We're lower this morning by 2 to 372.17 on a 2-year, 446.69. Yields unchanged on the session on the 2-year and largely on the month as well. The yield curve inversion has been driven by the drop in the 10-year yield, and we'll pick up on that a little bit later.
This is an important distinction.
That has been the story. Starting to price in that slowdown in the economy, not just here in America, but worldwide. In the FX market, off the back of some of this, it's been curious just to see how much dollar weakness we've had and how much euro strength has kicked back in. Euro dollar 103.64 on the month. The dollar is down around about 4.5%. So on course for the DXY to have its worst month, Tom, going back to 2010.
Yeah, from the tumult of October and September and all that. But John, I think you make a really good point, folks. When we trot out these spreads, and particularly for those of you that aren't global Wall Street, there's two numbers. In this case, the vanilla spread, the 2-year and the 10-year. And the story this month is not in the Fed policy talk. The story is it's going to be an economic slowdown, which is 10-year, price up, yield down.
And is duration a story you want to hold on to going into early 2023? Certainly that's the story for Bank of America and Michael Hartnett. We'll find out if BlackRock is on board in just a moment. Headline crossed the Bloomberg moments ago. Bramo, DoorDash cutting about 1,250 jobs in an effort to rein in expenses. Now, we're all wondering where the excesses have been maybe of the last 10 years. The investment has gone into projects, operations, businesses, Lisa, like this one.
Well, sure. There's food delivery. There's just broadly technology companies that haven't been making money necessarily, that are speculative in nature, that are getting really beaten down, and we keep hearing about that. DoorDash and the idea of getting, your $15 salad delivered to your home during the pandemic is going to become increasingly questionable as you start to get increasing price pressures, labor pressures, everything else, and people actually start going to the store themselves.
It's the story of the last decade, and it's the story of the last 12 months in the market as well. What's suffered is where the money has been going for the last 10 years. Into tech, into big growth names, into names like this one as well. Food delivery, Uber, Airbnb. You take your pick. Where the money hasn't been going, invested, CapEx, energy. What's delivered this year? Guess what? Energy.
There's a whole theory about how when you do get these bubbles of investment in other areas, real economy usually suffers, and then it rears its head, and you start to see commodity prices suddenly come to the fore because there hasn't been that investment. Some people have been looking at this cycle as this. Just a couple of names I'm going to run through that I'm also looking at. Wayfair. Just we were talking about the shopping center, like the shopping, the Black Friday, and then the Cyber Monday. Wayfair shares more than 7% because they indicated that Cyber Monday was actually really successful, and that they've seen a huge increase in some of those orders. State Street shares up more than 4% after ending their agreement with Brown Brothers Harriman. They're not going to be acquiring certain investor services, and you're seeing a pop there. And this, to me, is interesting. CrowdStrike Holdings, it's a cybersecurity company, down sharply, more than 18% after coming out with worse than expected projections. Our company is starting to pare back what they buy, what they invest in terms of their business services. Do you start to see some sort of crimping on that front as well as they start to gird for a more difficult time ahead?
You got any confidence in 23, Tom? Any clarity whatsoever?
Full disclosure, I don't have clarity, but I have confidence because there's so much gloom out there. There's so many people running. There's so much cash out there. You got to go against it.
Consensus at the moment is bonds for the first half,
going, he's nuts.
Equities for the second half, and Bank of America and Michael Hartnett. I think Hartnett at Bank of America would hate the idea of being called consensus, but I think, Tom, consensus at the moment is this idea that you hold on to bonds for the first half of 23 and you move towards equities in the second half.
Yeah, it's like the pivot thing. We're all trying to guess the x-axis out June of 2020. Why are we doing that?
It's tremendously difficult to do.
Yeah.
But it's that kind of year. It's the time of year, isn't it?
I'm
Get
just
a crystal ball
gonna
out and
look
you
at
start looking ahead?
I'm not doing crystal ball. I'm looking at the present, which is what Wei Li is doing. She's Global Chief Investment Strategist at BlackRock. Helped us out in London when we were there a number of weeks ago, and we're thrilled you joined us in New York this morning. I'm going to cut to the chase. What's changed here, not the crystal ball that John mentions, but what changed is that we have a risk-free rate. We have cash as values. We're getting on our iPhones. You two can make 3.2%. You know, it's like from another time and place. Now that the risk-free rate is back, we have almost a real money environment. What does that mean for asset allocation?
Well, as we enter this new regime, in fact, we're already in this new regime where it departs from the great moderation, and now we're in a world shaped by supply. In our view, it needs to it requires a rethink of asset allocation. You talked about risk-free rate. In fact, we think that the new regime requires a new playbook altogether. So we talked about forecast for next year. We believe that even as we enter a recession, which is our expectation for next year, inflation could surprise on the upside. It's going to be lower than what we have seen so far this year, but it could surprise on the upside because we believe central banks are not going to go all the way to fight inflation to bring it down to target. And at the same time, you talked about consensus. Right now, we're risk off. We're not that constructive on risk sentiment.
You're underweight equities, aren't you?
We're underweight equities. We remain underweight equities at this juncture. But I think what is more important is when we would become more constructive, and we expect to be more constructive at some point in 2023. And having that mechanism of gauging when to turn positive is important. Sizing the damage of the macro scarring as a result of central banks over tightening, and also understanding to what extent that damage is in the price is going to be critical as we think about when to turn positive. And also importantly, as we turn positive, it's not going to be the prelude of a decades-long bull market that we have seen in the past. We believe that it's going to be a lot more volatile, a lot more choppy, and again, here sizing the damage, understanding what's in the price is going to become
What's shaping your view about that shift in the market regime? What drives you towards making that conclusion?
It's very much around our conviction that we're in a world shaped by multiple factors of supply constraint. Yes, of course, energy prices coming down a little bit and some of the supply bottlenecks is getting alleviated. But looking beyond that, we're still facing three structural catalysts for elevated inflations in the long term. So aging demographics, over the last 15 years in the US, actually participation rate went from 68% to 62%. That is wholly explainable by aging demographics. And also we have geopolitical fragmentation that represents further supply constraint, reshoring, friendshoring, as well as the net zero transition, where we believe that there will be a mismatch between demand and supply. Just like during the pandemic, there was a mismatch between demand and supply, and that pushed up inflation. So we see this persisting, which is why even as inflation goes down, as we look at next year, we believe that it's going to settle higher versus the pre-pandemic levels.
Given that, how much conviction can you have going into long duration?
Currently, we actually want to push back against this notion that as we enter a recession, you just automatically hide in long duration bonds, because this recession is going to be caused by central banks over tightening versus previous recessions where central banks are expected to come to the rescue and cut rate. We actually don't believe that developed market central banks, in particular the Fed, is able to cut rates next year. Markets are pricing rate cuts, a pretty aggressive rate cut cycle, but in the face of this persistent inflation and supply constraint that I just talked about, we believe that they're going to hike and stay at those levels for an extended period of time.
This is an important day for China. One of your leaders has died, and I want to go back before you were at the University of Cambridge. You did something no one we've ever talked to did, which is you did the Mathematical Olympiad in your China, not once but twice, which is, folks, trust me, unheard of. How do you perceive the leadership change that we see? I don't want you to get in trouble with BlackRock, but the new China or the next China, what does it look like to you on this day where Xi dies?
I think one big takeaway from the party Congress earlier in the quarter is that focus is broadening out from growth to social coherence, common prosperity, national security. And what that means over the longer term is that we should expect a lower trend growth for China. And also in terms of the transmission mechanism from macro to micro will become less efficient. So all of that warrants a higher risk premium as you think about incorporating China in a whole portfolio context, which is why tactically we're neutral China assets even as the country opens up. But strategically, we're actually underweight China government bonds because of the yield attractiveness becoming less.
Wei Li, this was brilliant. I'm going to take the opportunity to promote some of the research over at BlackRock, Tom, because I think a lot of people outside of Wall Street may find it difficult
they're
to
underfollowed.
access
They're underknown.
certain research. No, to be clear here, Tom, the Investment Institute weekly note is available online on a website for everyone.
And it's terrific.
And it's a great read. I always enjoy it. Wei Li, fantastic, from BlackRock. Tom, not everyone can access.
No, it's true. Oh, I hear about it all the time. I hear about it all the time. You know, behind the walls of Wall Street, you know, they have to make a living and all that.
That wall is taken down at
BlackRock is, you know, making those brains accessible. Absolutely.
They can afford to, anyway.
Yeah.
You know, that's you know, they can.
Well, you know, on one hand, compliment, on the other hand, digging it out.
You know, it's
but,
what I expect.
I do think, though, what Wei was talking about was really interesting about how the knee-jerk response of going into duration isn't necessarily going to work, and that is a consensus trade among so many other people. It's fascinating to hear the pushback saying if we're in a higher inflationary regime and you're going to see rates higher for longer, it may not work.
What have spreads done in this month where the people are on the bid of bonds? I mean, the fact is everybody wants to own bonds, right?
It's been a huge rally.
What's the spread market done?
It's been a huge rally
High
across
yields
the board.
led the way?
Yeah, well, I mean, both of them. I mean, investment grade is sort of the consensus also that everyone's trying to hide back. But you've seen yields come in dramatically, so people are basically saying, let's go.
Are you getting on your phone like I am? You can make 3%. You know, you can make 2%.
Am I trading during the show? No.
No, but I'm for the first time in years, somebody's telling me I can do like a CD or cash. I haven't seen it in years.
Which bank? Who's texting you?
I'm not allowed to say on air.
A range of names. A range of financial institutions are looking for your savings.
Yeah, triple leveraged all cash is 9% clean before the 2 and 20
Click this link. Put your social security number
And on
in
a
it.
serious note, I caught up with Gershon Distenfeld of AB recently, and he mentioned the disconnect between the PMIs, which are softer, and credit spreads that are tighter.
Doesn't make sense.
And something's got to give. Either the PMIs are going to come back up, or the spreads have got to widen.
Yeah.
Something's got to give, and I guess I'll leave it for you to take your bet on what will. Neil Dutter's going to join us a little bit later of Renaissance Macro. I love catching up with Neil.
I do too. He's an optimist.
We're going to do ADP with Neil.
Sort of like me.
At 8:15, and then we're going to talk about the optimism for next year. Lisa's going to lead the way. What was your S&P price target?
5,000.
5K at some point.
At some point.
In the future.
Yeah, I didn't say that. I didn't say 1,000. I said 5,000.
No, 5K sometime, somewhere.
At some point.
In another lifetime. Of New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Washington, the leader of the right-wing Oath Keepers group, Stuart Rhodes, has been convicted of seditious conspiracy for his role in the storming of the U.S. Capitol in 2021. One other defendant was convicted of the same charge. It's the first trial, the most serious charge from the riot. NATO is being urged to send main battle tanks to Ukraine as soon as possible. Lithuania's foreign minister told Bloomberg that Ukrainian forces could use them to reverse the military situation while the ground is frozen. NATO foreign ministers are meeting in Bucharest. This month, prices in UK shops rose at their highest rate since at least 2005. The British Retail Consortium said shop price inflation accelerated to 7.4% in November. Food prices more than 12% higher, with meat, eggs, dairy, and coffee leading the way. The return of Disney CEO Bob Iger may not be cheap. In a filing, the world's largest entertainment company warned investors that changes in management and strategy being considered by the new leader could result in impairment charges. Last week, Iger said in a memo that he may alter Disney's management structure. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
The victories belongs to the brave Ukrainian soldiers, and the bravery and the courage they have demonstrated is so impressive.
With their blood.
Yeah, absolutely. But of course, the equipment that they have received from NATO allies has been critical for the gains they have been able to make.
Just moments ago, Jens Stoltenberg, the NATO Secretary General, sitting down with Bloomberg's Maria Tadeo in Bucharest. I'm pleased to say that Maria joined us right now. Maria, run us through what we heard from the NATO Secretary General just moments ago.
Well, look, Jonathan, this is one of the stories that, of course, as reporters, we always try to keep a distance and stay very objective. But what we're talking about here is a change in the war now that essentially moves from the battlefield to a goal of just making people freeze to death. And that's exactly what Mr. Stoltenberg told me. That is the situation right now. Russia targets now the infrastructure, the energy, and temperatures are dropping below zero in Ukraine. The question I asked him, though, is how do you fight a war of this nature? And this is what he had to say. Let's take a look.
President Putin is weaponizing winter, trying to make people freeze, and that is, of course, really something which is very harmful for all the civilians. What we do is to provide support to Ukraine, unprecedented level of support. Allies also made pledges to step up even more support, in particular when it comes to air defense systems, but also to help to repair and replace the electricity system and the power grid that has been destroyed.
And of course, that was the NATO Secretary General Stoltenberg speaking to Bloomberg just very briefly. Of course, the problem and the criticism here that you hear from the Ukrainians is that this help is great, is welcome, but it's not coming in fast enough. They fix something, Russia breaks it again, and therefore it's blackout and cold again. And this is a new type of warfare. The nature of it is almost perverse. This is no longer the battlefield. It's not an army that fights another army. This is now about civilians that could die this winter in the cold.
Maria, he is the former Prime Minister of Norway, and the view from Oslo is simple. Is Europe on the same page? Into next year, is NATO in unison? Is Brussels on the same page, or are there fractures and fissures?
No, I mean, what he repeated is, yes, we're on the same page. In fact, that is the biggest miscalculation that Vladimir Putin made going into this war. The idea that NATO, the West, and the European Union combined forces to help this country. But we know it's difficult. We see that there's a big diplomatic spat in the European Union over the oil cap. There's also a spat about what type of weapons should be sent to Ukraine. And then there's the biggest question of all, what happens if Ukraine gets to a point where it can fight over Crimea? Russia has made it very clear that is a red line that would be a severe escalation. And behind the scenes, some member states of the European Union worry what happens if it does get to that point where Ukraine and Russia clash over Crimea. What side do you take? Do you want to de-escalate or escalate?
Well, to that point of de-escalate and escalate, what is the military single need that Zelensky and the rest need? Is it airplanes? Is it air cover? Or in the headlines in the last hour, is it more tanks? What do they need now from NATO?
Immediately, what they need is air defense, because of course it prevents the damage from the sky from Russia, but it also prevents this damage that is done to their infrastructure when it comes to the energy. And again, we have to stress this, Tom. We're talking about people an hour away from Romania that could die in minus temperatures this winter. This is the reality of Ukraine at this point. Now, going forward on the military aspect, the counteroffensive, what they say is they need tanks, but there's a real debate about who's going to train them, who is going to oversee this. And if you go for long-range weapons, is that perceived by Russia as an escalation? Again, it's always this debate, what is self-defense and what is attacking Russia that could potentially go to an escalatory phase here?
Maria, as Europe grapples with this really horrific situation, there's an eye toward China in terms of how much of a reliance should Europe continue to maintain with a nation where there are a number of tensions that have continued to build. What did Stoltenberg say about that, especially as Emmanuel Macron prepares to go over to China and after Olaf Scholz just has returned?
It's an excellent point, because I counted the times he talked about China, and I was struck by the number of times he repeated the word China. And remember, this year, it's no coincidence. NATO changed its definition for China, which is now seen as a systemic challenge to NATO. And he told me in that interview he does worry that some in the West have not learned the lessons from Russia, which is trade and security have to be separate. At times, it's better to invest in your security, perhaps not so much in your trade. And then I also asked him flat out, do you worry about Taiwan? He tried to not answer that question. I pushed, and he said nothing good will come out of a situation where China is aggressive on Taiwan.
Maria, thank you. Wonderful work as always. Maria today there in Bucharest, sitting down with the NATO Secretary General. Looking ahead to next year, which is the game everyone plays around this time of the year, closing out November and going into December. Got to remember how we looked ahead to 2022, 12 months ago. And of course, in the outlook was not a war in Ukraine. That certainly was not the consensus view and was a big surprise, which shook up markets worldwide. Deutsche Bank came out with this quote this morning. This is great. With markets increasingly confident of a terminal rate around 5% and inflation getting back close to target in 2024, it's worth remembering that exactly a year ago today, markets were pricing a Fed funds rate of 0.68% by the end of 2022.
Yeah, thank you.
And economists were calling for CPI of 2.6%. The world changed, didn't it? And consensus got it just a little bit wrong.
And the sport and the art of guessing this has been the fabric of what we've done, John, for decades. And the answer is people get it right, people get it wrong. It's how they adjust and adapt along the way. I give great credit to the crew that believed in higher interest rates and non-transitory inflation, who were there early and then stayed with that call.
The point of this quote from Deutsche Bank, Tom, and the point I think of the exercise of having these outlooks around 2023 is to identify what the consensus is. And I think over the last couple of weeks, we're putting that together a little bit more, Lisa. And then to work out which part of that we should really be questioning a little bit more. And the point that Deutsche Bank's making this morning, ultimately, is it's remarkable how settled the consensus is around a terminal rate of 5%. Should we be questioning it more? And clearly, I think we should.
Another way to put this is, what's the biggest pain trade for next year? And if you believe some of the consensus trades so far, the biggest pain trade could be that we don't get a recession for the bulk of next year, that you end up with rates staying higher than expected, that this is going to blow out the long end of the curve, the 10-year treasuries, the 30-year treasuries that people have been piling into, that the dollar will re-strengthen when so many people are expecting it to weaken, and that you are not going to see outperformance in emerging markets and in China. Those are some of the pain trades that go against the consensus that we keep hearing.
Sounds like Neil Dutta of Renaissance Macro, doesn't it? Isn't that his view going into next year?
Let's find out.
He's going to join us in around about, what, Tom, 20 minutes from now?
Yeah.
Around
like
ADP
that.
when we get that report.
Yeah, well, we've got the ADP report and the jobs report. And again, is Powell going to mention this today? I don't think he is. He's just going to say the labor economy looks great. You've got Marty Walsh on Friday. He's going to say the same thing.
Looking forward to that conversation on Friday, specifically around the unions and what's going to happen with these round negotiations. That's a conversation for Friday. Chairman Powell coming up a little bit later, 1:30 Eastern Time. Futures positive 0.2%, live from New York, heard on radio, seen on TV. This is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
What the Fed wants to do right now is switch from a speed paradigm to a destination paradigm.
Between the three Fs, the Fed, fiscal policy, and financial conditions, it will be enough to cause meaningful disinflation.
I think there is going to be a recession. I think it's going to last quite a while, but it's not going to be a dangerous recession.
Everyone's talking about recession. Everyone's talking about earnings coming down. And so the surprise is that they hang in there.
Investors should be in it for the longer term. Recessions are always temporary.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television before a speech by the chairman of the Federal Reserve. Sounds like a Fed show, John. We're about 4 hours early
well, I guess it is.
For the chairman, but it's a Fed show today.
The Fed is worried about undercooking it, not overcooking it. The Fed is worried about stepping away too soon, not sticking with it too long. And I think the labour market data we're all expecting on Friday and the labour market data we've seen so far keeps the door open for them to maintain that stance, Tom.
On my sabbatical that I took off, thank you for watching. I watched every minute of the World Cup that I could. And John, to me, the great miscall has been the recession gloom all of 2022. And the truth is, we're not there yet.
Push that weakness out to 23, haven't we? And it gets pushed out just a little bit further. Neil Dutter's going to be with us from Renaissance Macro in about 15 minutes' time. He's been great on this. And I think that's the question he's asking Evan Brown over at UBS. Can this economy keep surprising to the upside? And if you break down the economic data that we've had over the last couple of months, and you can do that on the Bloomberg, where you've seen the upside surprises, it's been in the labour market. It's been in the labour market. The labour market continues to surprise to the upside. And we'll see a little bit later today if it surprises and jolts, and if it surprises again on Friday with payrolls.
At least it's old news now. Retail sales a couple days ago, but up 7-8%. Solid. Black Friday, Cyber. What's Wednesday? Is it like
Joyful Wednesday.
Christmas tree Wednesday.
Joyful Wednesday. Joyful Wednesday.
Very nice, very sensitive.
There still is strength in this economy, which raises a serious problem for a Federal Reserve that would like it to cool off more quickly. Narayana Kocherlakota, formerly of the Minneapolis Fed, came out with this column on Bloomberg this morning that I thought was fascinating, where he said basically a bit of stagflation is just what the Fed should be and appears to be aiming for, that they want stagflation at a time where they need inflation to roll off, they need the unemployment rate to go up, and that's just going to be the reality for a while.
But my reality is, and this comes from Brookings Institution, where the chairman will speak today, is inflation affects different parts of America. Part of America is living Kocherlakota's stagflation. Lisa, part of America is going, what? This is great.
Which is a reason why inflation can keep rising for longer, prices can keep rising for longer than many people can stand it. And this is going to be a huge problem for massive groups of the population, even as the wealthiest individuals still have money to spend and are spending it.
John, I'm going to go to the Fed calendar, click forward to 2023. Which meeting matters to you? I don't have it memorized. February 1, March 22. Do we need to go out to May 3rd to get a decision on this?
I think you go out to the second quarter.
Yeah.
I think you've got to go out to the second quarter.
Yeah.
Where does inflation need to land, Tom, for them to be confident? They're not going to keep hiking until they get to 2. Let's be clear about that. They'll keep hiking until they are confident that we're on the trajectory back towards 2%.
So what Blanchard wrote a couple days ago in the FT, everybody knows my affection for Olivier Blanchard.
And let's be clear, 1 month of CPI surprising to the downside is not going to do it. 2 won't. 3 maybe. I think they want a handful before they really step away from this. And when it comes to risk management, you hear it again and again and again. They think the risk of doing too little outweighs the risk of doing too much. And I would say the bias is, at the moment at least, to overcook it and not undercook it.
Our guest is too wise here to waste. Let's get to the data check, John. I don't even know what to look at. I guess I'm going to look at the Bloomberg Financial Conditions Index showing accommodation that the chairman doesn't like.
Equities up on a day, up on a month. We're up on a session by a little more than 0.1% on the S&P 500. Futures positive, just a little bit elevated. In the bond market, down on the session, down on the month. 10-year Treasury yields 3.74 right now, Tom. And on the month of November, down about 30 basis points. Surprise of the month, maybe. The amount of dollar weakness we've seen. Euro dollar 103.68. That currency pair positive 0.4%.
To recalibrate, to readjust, maybe out to December 15th or maybe on to January 1, and then the view forward is a challenge this year like maybe there's never been. And Woody Bogana joins us right now. I had a multi-asset strategy in Boston's Columbia Threadneedle Investments with a very detailed note. What is your degree of confidence to get out to June of next year? Or are you going to have to recalibrate January 20th?
We'll have a couple of inflation prints by then. So to the discussion, John, you just had, 1 month won't give us that confidence, but a couple more prints and all the forward-looking data that I'm looking at, the leading indicators of the inflation data, that's pointing to some moderation. Not at the rate that we want, but the direction is right. In other words, it's moderating.
Yeah, John, I just went to January 20th because Man City plays Tottenham.
Oh, right, you've got that in the
back
diary,
on
have you?
January 19th, and that's when the guy in Brazil with that incredible kick will be back with Harry.
Think about just to run in the conversation a little bit more, Tom, if you can.
Thank you.
Through the next 60 seconds. And Whitty, I think it's difficult to be in markets right now. Even if I can guarantee the economic data, can you tell me what the outcome will be? Wei Li of BlackRock was on with us about 15 minutes ago. And she pointed out that she thinks even if we get an economic downturn, the long bond's not going to work, that we won't get that rally at the long end of treasuries. What do you say back to that?
No, I think long end of the Treasury is looking quite attractive to me. Finally, we are seeing a month where it's actually being a hedge to any bad surprises on the growth front. So, we are adding to the long end at this point.
So how do you push back against the scenario that she was basically talking about, that you end up with a more protracted inflation, that the economy doesn't go into recession necessarily as quickly as some people are expecting, and that you get a Fed rate that stays high for a lot longer than people are pricing in?
Right. So I'm quite sympathetic to the view that data actually in this next couple of quarters might actually be better than the recession fears, which is, as usual, pushed to the second half of the year. And in that case, the front end is risky to me. But as you've seen through the last few months now, the long bond has been the curve has been inverting. In other words, the long end is saying that even if it's not next year, Lisa, in 24, 25, we are going to see some sort of slowdown in growth, which is severe enough for the Fed to start cutting at some point.
We were just talking about this column by the former Minneapolis Fed President, Coach Lakota, where he was saying stagflation seems to be the goal, not necessarily a potential consequence of the Federal Reserve, at least in the short term. What does well, asset price-wise, in stagflation?
Not much. Stagflation is not really a great place to be from a multi-asset portfolio perspective because bonds don't do well. Maybe commodities do well. Commodities is a good place to be. And then you're looking at relative value trades, value over growth, some sort of alternative trend players, nothing in the traditional sense of your standard growth stocks or bonds.
But the traditional sense has been shattered this year. Some would say in equities, certainly NASDAQ, and definitely bonds, and definitely the meat of what Columbia does, which is 60-40, that kind of allocation. Yep. How do you reallocate? Do you get back to a traditional model next year, or do you just have to wait completely ex post out to 2024, or even, dare I say, 25?
I think you start inching in. You're seeing improvement in data, Tom. You're seeing inflation starting to come down. You're seeing growth actually stronger than expected. So we are neutral equities. I would not be short equities.
What does that mean? What does neutral equities mean?
It's very different for everyone.
You either own it or you don't.
No. You own to your policy benchmark. So if you are a 60-40, you own 60. If you're a 20-30 or 20-70, you own 20.
She's talking institutional here. My policy benchmark is I can't retire.
And Willie, to your point then, do you stop listening to the Fed speak? Do you start to ignore that now?
You can't really afford to ignore the Fed speak. I will be listening into a Brookings presentation this afternoon, which is not even FOMC.
But does it lose relevance given what you're expecting into next year and what they're trying to signal?
I think what you're looking to see is their reaction function changing? And that you can only gather by listening to all the speakers and what they're saying.
And how do you think they respond to a mild, short and shallow recession? Is it your understanding that they don't cut interest rates if we get that next year?
No, I think, they will respond to a growth
because they're telling us they won't.
Well, we haven't seen that data yet, Tom.
And that's the problem, Tom. That's the problem. I think that's the biggest issue I've got with next year. We're pricing in cuts, and the Fed's effectively telling you that if we have a short and shallow recession, they won't cut interest rates. But this goes to the Wei Li call over at BlackRock. This is why she wonders whether the bond market story is going to work in quite the same way in this downturn. It all comes down to how the Fed's going to respond to it.
I've never seen this much navel gazing. To me, it's ridiculous.
Tom, it's part of the business, isn't it?
No, but we've taken it to a new extreme now with this pivot. Help me, Lisa. There's this vector out, higher yields, and then boom, we're going to switch. Come on, it's too easy.
We don't have anywhere else to look other than our navels because our crystal balls are completely broken. There isn't necessarily a trend. That's the reason why I think that there's a lot of speculation in trying to game out the possibilities. You ask a good question, Vanwidi, John, which is, do you even pay attention to Fed speak if the market is shrugging it off and saying the data is more important, and ultimately Fed officials will focus on the data? The reaction function is fascinating. What is the trigger to say inflation is coming down fast enough that we're okay pulling a foot off the brake?
Clearly November and December is too early to do so. I talked about the labour market leaving the door wide open to maintain this stance. You'd argue financial conditions are leaving the door wide open for them to maintain this stance as well, because it gives them something to lean against. You saw how aggressive Chairman Powell was in the news conference. I just wonder how aggressive he might be a little bit later.
People would push back and say we've already priced in 5% peak Fed funds rates next year. So it's what else can they do? If they don't say it's happened yet, it's not going to be a big problem. Other people might say, maybe you haven't priced in the payment.
You know how to get the most out of Chairman Powell in an interview? Just pull up Bloomberg anywhere and say, stocks are up. What do you think?
Bad. Come down.
That was in a meeting.
Then get the hawkish greatest hits from Chairman Powell.
And I mean, and Woody, this is really important. Can you, from an institutional, well, we're going to have to go here, but my fault. But I mean, seriously, to all of you, can you call market bottom here? That's the key question.
I still hear people saying 3,200. That's 20% in the other direction.
I agree. That's what makes it interesting.
Some big calls.
I've heard
wide
5,000.
ranges. 5K was you some point somewhere in the future.
And Woody's got to come back and talk about the Red Sox.
And Woody, this was great. Fantastic to see you. Thanks for being with us. We're going to catch up with Neil Dutz of Renaissance Macro in the next segment. ADP just around the corner from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve Chairman Jerome Powell may cement expectations for a slower pace of interest rate hikes in the U.S. today. Powell speaks at an event in Washington. He may echo former Fed officials in signaling a half-point rise at their final meeting of the year. Inflation in the Eurozone has slowed down for the first time in 1.5 years. The reading for November was 10% less than the median estimate. That offers a glimmer of hope to European Central Bank. It struggled to curb the worst inflation and consumer price shock in a generation. New York Congressman Hakeem Jeffries is likely to make history today. House Democrats are expected to elect him to be their new leader. That would make Jeffries the first black person to lead a major political party. Nancy Pelosi is giving up her leadership role as Republicans prepare to take control of the House. The U.S. Senate has passed a bill that enshrines federal protection for same-sex marriages. The vote was 61 to 36, with 12 Republicans joining the Democratic Party majority. Democrats raised concerns that Supreme Court could overturn a ruling that established the right to same-sex marriage. That measure now goes to the House, where final passage is expected. Former Chinese President Jiang Zemin has died. Jiang presided over more than a decade of dramatic economic growth following the bloody 1989 crackdown on pro-democracy demonstrators in Tiananmen Square. China's economy more than tripled in size in 13 years. Jiang was in power. At the same time, though, he resisted political reform. Jiang Zemin was 96. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How do Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
They're stressing the longer rather than the ever higher. So I think once we get to 5.25, 5.5, I think they'll relent, and then they'll just sit there and wait for that restrictive monetary policy to slow the economy down, generate more slack in the labor market, and that will gradually push both wage inflation and services price inflation down.
That was the brilliant Bill Dudley there, the former New York Fed president and current Bloomberg opinion columnist, just getting some ADP jobs data across the Bloomberg terminal. Mike McKee has that for you. Morning, Mike.
Good morning, John. Well, if you're in the camp that is waiting for the labor market to cool off a little bit, ADP gives you some backup information on that. Not sure what to make of ADP. It's changed its methodology, but they say employers added 127,000 jobs in the month of November. That is the slowest in the last 12 months, at least, they say. And they break it down by saying we gained 213,000 service industry jobs and lost, it appears, the press release is a little off here, but it looks like we lost 86,000 jobs, 2,000 in construction, 100,000 in manufacturing. Now, that's a huge number. It'll be very interesting to see what happens when we get the ISM tomorrow and when we get the payrolls report on Friday. ADP now includes a pay component, and according to them, pay growth moderated up by 7.4% during the month. People who stayed in their jobs saw an increase of 7.6%. People who changed jobs, 15.1% more money. And just one other stat, briefly looking through this, in terms of jobs in the South. West, South, Central, they say they lost 28,000 jobs. I don't know exactly what their map looks like, but one would expect jobs to have been lost in the southwestern Florida area after the hurricanes. So that may be part of what brings in this very slow number.
The ADP report, Tom, There's nothing else like it. Everyone looks at it and nobody knows what to do with it. It's always the same every single month.
I'm trying to be polite here to the great Mark Zandi,
it's like
who
downside
helped
surprise.
invent this, and it's been reinvented. I really pay attention to what ADP, automatic data processing, says about payroll and paychecks and what we're doing when we get the piece of paper, because they're the ones that invented that. Good morning to the good people at ADP. Other than that, John, my head's spinning.
Hey, Lisa, everyone's, right? Everyone looks at it and no one knows what to do with it.
Correct. I do think that Neela Richardson, who's the chief economist over there, is a brilliant woman who always has really interesting insights. So I'm very curious that she said this. Turning points can be hard to capture in the labor market, but our data suggest that Federal Reserve tightening is having an impact on job creation and pay gains. Companies are no longer in hyper replacement mode. Fewer people are quitting, and the post-pandemic recovery is stabilizing.
And that is a takeaway. Jolts, right? Am I right that McKee told me years ago Jolts matters?
Well, that comes to this labour market rebalancing act, and we'll talk to Neil Dutter about how relevant, how instructive Jolts actually are at the moment. Yields are coming in just a little bit on a 10-year. We're down 2 or 3 basis points to 3.72. Equity futures still positive, up a third of 1%. Mike, great to catch up with you, sir. Mike McKee breaking down the ADP report. Tom, 127,000 the estimate was, 200K.
We calibrate and we listen and we lean forward when Neil Dutter speaks. He's head of U.S. economic research at Renaissance Macro. He is followed for his inherent optimism and his specificity. Call it the BS factor of the data. We're thrilled he could join us on set this morning. Neil, I love in your terse note, always terse, you say, so what, to all the GDP navel-gazing that's going on there? What's the reality of American economic growth from the Dutter so what perspective?
Well, Tom, I think the reality is that financial conditions have been, well, they've been easing over the last month, but up until a month ago, they were tightening for the better part of 12 months. And now, for all the talk of long and variable lags, the economy is now tracking, in real terms, 4.5%. And consumer spending is tracking 5%. So the Fed is telling you that they believe that their policy works through financial conditions, and they affect interest rates and exchange rates and equity market sentiment to some extent. And that has effects on different parts of the economy. So let's just go down the list. Credit card rates are going up, auto rates are going up, and yet consumer spending is tracking 5%. You talk about the dollar, which is now going down. It's almost perverse, right? The Fed is trying to run a more aggressive policy relative to its central bank peers, and yet the dollar is going down because there's enthusiasm that, people in Europe won't freeze to death, and that China is maybe reopening, and so that's providing some optimism around the global economy. The dollar's coming down, and guess what? The trade deficit's been narrowing. So, yeah, I mean, if their goal is to slow the economy, I just don't find that much success.
How do you view ADP numbers within this morass?
Well, I mean, I take a holistic view of the economic data. I think that's the right way a business economist should do their job. So I look at it, okay, 127,000, but I think Mike said that 100,000 off on manufacturing. Yeah. I mean, okay, the data are probably real, but the news is fake, right? I mean, there's no way that 100,000 people in manufacturing lost their job, not with Boeing having to do what it has to do, right? I mean, they have a huge backlog of planes they got to build, not with auto production continuing to go up. We know that motor vehicle assemblies need to rise. And look, the dollar's coming off. That's going to boost exports. So, I mean, okay, like, great. Their number said 100,000 jobs were off in manufacturing. I doubt that's how many people in manufacturing actually lost their jobs.
Too much optimism.
Too much optimism.
It's not.
I mean, not optimism.
Because
what Neil's identifying is a re-acceleration in the economy.
Right.
Which is that optimistic?
Is that optimistic when it comes to what the Fed might have to do?
No, come on. 90% of the street disagrees with what he's saying.
Absolutely, but Neil has identified a re-acceleration.
So no, look, if you look at, okay, I mean, the trusty Bloomberg terminal, okay? Real GDP, Tom, Q4 2022, 0.5%.
There you go.
Do you know how much of an epic decline in growth you would need to see over the months of November and December in order to achieve that forecast?
It's good for ratings, come on.
Q1 and Q2 of next year, respectively 0.1 and minus 0.1%. Again, okay, I mean, maybe. I would take the other side. So it's not to say that a recession is not going to happen, right? In fact, I think that's, in many respects, I think the Fed may view that as the solution to dealing with the inflation problem. The question is, what's going to happen over the next 3 to 6 months. And I think the consensus is, they're underestimating growth at the moment. And if that's the case, and that's driving a lot of these views for, the Fed's going to be cutting in the back half of next year or at the end of next year, that to me looks off. So I think the risks to growth right now are skewed to the upside. Doesn't mean that the risks aren't skewed to the downside later.
Tease for the next segment is, are we underestimating the terminal rate at the Federal Reserve going into next year? Neil, that's a tease. You don't have to jump in now. Got to wait. Mystery. Drum roll. Neil Dutta of Renaissance Macro is going to stick with us. TK, that's the view from Neil and the team of RenMac. And you see it in the data, don't you? We're not seeing that collapse in the labour market that people thought we'd see year-end.
The uncomfortable feature of Dutta is then he has a paragraph of actual data or what out there that's been off the mark. And, it's a major call. John, you highlighted this with Neil Dutta. He's really nailed the tone here of waiting for the gloom to happen.
We're going to pick up on that. And Neil made a monster FX call on sterling, believe it or not, a couple of months ago.
Super well informed.
That worked out for very different reasons, okay?
We'll go into that.
From New York, this is Bloomberg.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
commercial break. Out of control. Thinks that Neil Dutter's got goats on his tie.
Yeah, for those of you on radio.
Reindeer.
Festive.
Some economic data just dropping across the Bloomberg. Mike McKee back with us. Hey, Mike.
Good morning, John. Well, Neil has been right about a number of economic data, but the trade balance, not one of them. He noted it was shrinking. It is widening. The advanced good trades balance for October, $99 billion. That is down from, or wider from, $91.9 billion in the month of September. So that's going to be a subtraction from the fourth quarter growth. This is the first month of trade data for the fourth quarter. Wholesale inventories are up by 0.8%. A bit of a worry. That may be a reflection of the fact that we're importing more stuff. Retail inventories fall 0.2, though. So inventories combined is probably not going to make a major difference in what people's fourth quarter growth forecasts are. And again, these are just for the first month of it. And finally, we have the second reading of GDP, the first revision, up to 2.9% from 2.6% as consumer spending rises 1.7% compared to 1.4% in the initial release. The price index 4.3% from 4.1%, but that's a quarterly average. So at this point, tomorrow's PCE numbers will be much more important to the Fed. So it does look like a little bit of slowing for the growth picture out there in the fourth quarter, but third quarter revised higher.
Mike McKee, thank you. Neil, you've looked at the same economic data. Your thoughts on what you're seeing on the Bloomberg?
Well, I mean, one of the reasons why inventories fell in October at the retail level is because we had a absolute blowout in retail sales. So think about what the inventory to sales ratio is looking like in the retail sector. I'm guessing lower. So I guess, one of the ways that a recession works is through some element of surprise. Companies think that things will be okay, then something bad happens. They have to clear out inventories and they're hiring and adjust their CapEx plans and so forth. But what if the process works in reverse? What if we've been talking about recession, since June of this year, and companies have been adjusting to some extent. I mean, inventories have been being pared back. CapEx has been slowing somewhat. And what if they're surprised the other way now? What if growth is accelerating and the recession they anticipated didn't happen?
So let's get our teeth into 23. What we're really discussing here is what is wrong about the consensus. Deutsche Bank came out a little bit earlier this morning. I'll share this quote with everyone who might have missed it a little bit earlier. It's worth remembering that exactly a year ago, markets were pricing a Fed funds rate of 0.68% by the end of 22. Economists had CPI at 2.6%. Given the huge forecasting miss over the last 12 months, it's remarkable how settled the consensus is around a terminal rate of 5%. Their question, I think, is your question. Should we be questioning 5% a whole lot more?
Yeah, I think the risks are skewed to the upside. I mean, when Chair Powell tells you that he doesn't know what the path for rates will be, he just knows that it'll be enough. I think you have to take that as a signal that they're willing to do more rather than less. And if real economic growth is accelerating, which I believe it is at the moment, then that puts pressure on resource capacity. And that in turn puts upward pressure on prices. So a lot of the things that people are talking about, with respect to some of these bullwhip effects, in household durable goods, that could prove transitory. So, I hate to use that word, but that's sort of where I come down on this. I mean, ultimately, people look at what's going on with car prices and prices for household durables. They're coming down. Okay, rents are coming down. But if aggregate incomes are still growing at a healthy pace, all that's doing is freeing up people to go spend money somewhere else. And, if savings doesn't really go up, then that's going to drive up the prices for the goods and services that they start to spend their money on.
If you're bullish on the economy, does that mean you're bullish for risk assets for next year?
No, I don't think so. I think that we're probably in for a period of below trend returns in the equity markets.
So parse that out to this idea that we're going to see better than expected growth in your estimation, that you're seeing ongoing resilience, that's bad news.
Well, I don't want to fight the Fed, right? I mean, it's very amusing that so many of the people that following the financial crisis, the Fed is just driving up stocks, and it's the balance sheet. Well, like now, if you don't want to fight the Fed, that means you should be cautious on stocks.
I looked, Neil, at the math here on the second look GDP, and let's call it, and this is completely amateur, folks. We got a real GDP 2.9%, a price index of 4 point whatever percent, and we come out to some form of nominal spirit of 7.2%. We finally got a risk-free rate where, you know, money actually is not free anymore. Do we adapt? How do we adjust to going back to what we knew decades ago, with a substantial nominal GDP? Money now actually costs something, and I don't sense any gloom from you. We'll be fine, right?
Well, I don't know. I mean, I think my view is that if you're thinking about the next 2-3 years, we will probably we need a period, I think, of below trend growth to wring the inflation out of the system, right? So even though we may be accelerating.
Under 3% real GDP?
Yeah, most likely.
I mean, Ferroli over at JP Morgan, John, is like even lower than that as a run rate.
I'm looking at 0.4 for 23 on the Bloomberg.
But the question is, I mean, forecasting out 12, 18 months is difficult. Agreed. What I have more confidence in is what's happening right now. And right now, you know, even if you believe that we see some below trend growth for a longer period of time, right now things are looking a little bit better. And so I think that's really the tension.
When they start talking about long and variable lags, what do you hear when you see that in the statement? Because we had a story of two parts around the last Fed decision. You had the statement, then you had the news conference. Can you walk us through how you interpreted the statement in that line, which many people attribute to the vice chair?
I think the Doves made a great trade. I mean, if you're sitting around the FOMC table and you're Lael Brainerd, you got them to codify that into the statement in exchange for them to say something about neutral interest rates and, you know, puffing their chest at the press conference. But that's all later. That's like 5-6 months from now. Lots of things can change. The data can go their way, the Doves' way. So you're trading the certainty of stepping down to 50 basis points now in exchange for the uncertainty around what neutral rates may be. And so in my view, even though you know, that was a down day for markets and financial conditions tightened, so the Hawks looked like they may have won, I think actually the Doves played their hand pretty well. And I think that's part of the problem. Well, that it's too soon for the Doves to be winning any of these debates.
This is the reason why there are so many people who still believe that the Fed's going to not raise rates to the point that you're saying, that perhaps 5% will be the ceiling, and that they could even start cutting rates next year. What gives you confidence that the Doves aren't going to win another trade, that they aren't going to make something else that really complicates the message when you say don't fight the Fed? It's not clear what that means.
I think the data will make it, I mean, to me, the data will not make it tenable for them to make their case for cuts, because the unemployment rate would not have gone up enough in order to justify that outcome. And, you know, look at what's already happening. I mean, interest rates down. Oh, look what's happening. Purchase applications going up for mortgage demand is rising. The dollar's going down. Have you looked at the performance of industrial stocks lately? Global growth may well be picking up next year. What do you think that's?
Caterpillar was stunning.
What do you think that's going to mean for U.S. manufactured exports? Frankly. So what if companies are done with the inventory adjustment?
So do you not share the housing gloom that's out there? It's tangible.
No, I mean, look, the housing market is the one area where the Fed's policies has gotten a lot of traction. But now interest rates have come down a little bit, and that's unlocking some activity. And up is ultimately up. I mean, this is one of these arguments, oh, look at new home sales. It's all about cancellations. I mean, give me a break. I mean, up is up. The fact that people are signing...
There we go. That's the data we know.
New home sales...
Up is up.
New home sales are booked when a contract is signed. Are people not knowing what the interest rate is when they sign that contract? The fact that they're signing the contract, knowing what the rates are, is a sign of confidence in and of itself. If you look at the last conference board survey, or the last couple conference board surveys, people see rates to be somewhat lower in the year ahead, and what happens? Buying conditions for homes go up. So I think if the Fed pauses, rates come in, I mean, yeah, residential investment's not going to be as much of a drag in Q2 of next year as it is at this very moment.
Call of the month. We haven't mentioned it. Neil Dutta comes on the programme. Do you know what he says, Tom? He says long sterling. I'm bullish sterling and Rishi.
103-ish?
Cable. Now back up to 120. Got any more FX calls for us?
Yeah, exactly.
No.
Neil Dutta of Renaissance Macro.
Do you have a sweater to go with your tie? For those of you on the radio,
festive.
we're looking for the Christmas
Can
sweater.
we clear this up? Can we zoom in? Because I'm getting people writing in now.
They look like goats.
People are agreeing with Lisa and saying they're
look like goats
and not reindeer.
These are deer with
They've got antlers.
Wreaths around them.
They
they're so festive.
Nice big ears. It's like
Bambi. Have we settled that now?
He says they're reindeer.
Do you have a sweater to go with this? Can we get you on before Christmas with this sweater?
Sure. I'll be happy to put on my Mr. Rogers look for you.
Very good.
Are we going to do Christmas sweaters? Are we doing that?
Please do.
No,
I think that you should, with like a little bow tie around them.
I would do that for you.
I think, really?
Yeah, of course.
Aw.
I'm very
Like
festive.
Little like pom-poms and little
I'm a
things
very
like that.
joyful guy around Christmas.
Do you know who owns a high ground
I
on
like
this?
that, like,
you laugh?
caveat.
Do you know who
I'm a
owns a high
very
ground
joyful
on
man.
sweater territory?
Who does?
Ira Jersey owns the high ground.
I didn't know that. Does
in
he?
Sweater territory. Yeah.
I thought he collected football scarves.
He's got the same thing. It's a scarf sweater combo.
Okay. Up in the next ad, James Athey of Aberdeen.
When I
Looking
saw the
forward to that.
tots, I looked for
Matt Hornback at Morgan
shopping.
Stanley.
You come out of the Tots Stadium.
Matt's got things to say. Emily Hill of Marisol Capital Advisors coming up in the next hour.
Did you move France Tunisia later so you and I could watch it?
10 o'clock.
Thank you.
Yeah, then 2 p.m.
It's good that they
Argentina.
moved it.
As you know, scheduling the games just first
Australia.
time after
Why is Australia playing against France? It's not fair.
What you think they should get a buy into the next round? That's how that
Can I
should
say
work.
the unpopular opinion?
Go on.
World Cup.
Why am I surprised?
World Cup is going to be the new Olympics.
Oh, please.
What? I actually do think so, because it's like, national kind of collective pride, but it's actually more focused.
Where have you been for like 50 years? And,
living under a rock.
Americans discovering the World Cup, this brand
still
new
am.
shiny thing
100%.
came out this year in Qatar. I think this is going to be the new thing.
But why is the goal so small?
Tom would say that. You want bigger goals, don't you?
I want to kick from farther out. No, I don't want the goal smaller. I love the goal size. All the hitting off the post is great.
After this fantastic, sophisticated conversation we just had with Neil, we're going to wind it down by talking about
farther out.
bigger goals.
Tee it up.
All right. Team USA. I was so happy about that. I think it's great.
It's exciting.
From New York, this is Bloomberg.
Football and finance on surveillance. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, in Washington, the leader of the right-wing Oath Keepers group, Stuart Rhodes, has been convicted of seditious conspiracy for his role in the storming of the U.S. Capitol in 2021. One other defendant was convicted of the same charge. It's the first trial of the most serious charge from the riot. NATO is being urged to send main battle tanks to Ukraine as soon as possible. Lithuania's foreign minister told Bloomberg that Ukrainian forces could use them to reverse the military situation while the ground is frozen. NATO foreign ministers are meeting in Bucharest. Mortgage rates in the U.S., they fell last week to the lowest level in more than 2 months. That extends a recent decline that is providing some relief to a weakened housing market. According to the Mortgage Bankers Association, the rate on a 30-year fixed mortgage fell 18 basis points to just under 6.5%. The return of Disney CEO Bob Iger may not be cheap. In a filing, the world's largest entertainment company warned investors that changes in management and strategy being considered by the new leader could result in impairment charges. Now, last week, Iger said in a memo that he may alter Disney's management structure. Apollo Global Management knows how to rock. Bloomberg learned that the firm is selling a $1.65 billion bond backed by songs from Phil Collins and the group REM. It's the first securitization by Concord Music royalties. Apollo has already secured an anchor order for a large chunk of the debt. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist. And I think we are witnessing right now a societal change in the way we work. You're no longer going to measure productivity in the same way as in the past. You're going to be focusing on output. Never mind what people do in their private times. It doesn't really matter to a company as long as the output is there.
HPE launched its Edge to Office hybrid work initiative in the fall of 2020. The new campus is designed with that flexible model in mind.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Stages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
If the labor market is staying tight, then there's a bias that the Fed has to, kind of extend and do a few more 25 basis point hike. Can we get to a 5.5%, 6% expected terminal rate? I think we can. And ultimately, that can be the thing that makes the economy crack down the road, but it's too early to trade that.
Evan Brown, UBS, thrilled that he was with us. UBS Asset Management had a multi-asset strategy. We will stop now and look at a 10-year plus project at Bloomberg, which is Bloomberg Intelligence. If you have a terminal, it's become something that you either look at and talk about, or far more importantly, it's something people on Global Wall Street look at, but they really don't want you to know they're looking at the quality of Bloomberg Intelligence. It's maybe a secret for Global Wall Street. Gina Martin-Adams drives forward the equity coverage and joins us today with something that is beyond sobering. Do you want to beat the Standard & Poor's 500 by 440 basis points over a good, solid decade plus? Gina Martin-Adams on the Bloomberg Intelligence MVP portfolio. Gina, I'm blown away by the math of this. What is the dominant factor that leads to the outperformance of an MVP portfolio that includes something like Marathon Petroleum?
Yeah. So thank you, Tom. The MVP portfolio is actually a combination of equal weighted factors, and I think that's the magic behind it, is we include technical and fundamental factors to select stocks. We screen the S&P 500 for the highest momentum, highest value, lowest volatility, and highest profitability securities on a quarterly basis.
Right.
Take only the top 50 and then rebalance it every quarter, and it has proven to be a very strong risk-adjusted return.
portfolio, especially relative to the broader S&P.
It is factor-based, and what our radio and TV audience needs to know is that folds into the timeline or the terminal rate. Is your timeline of study on these companies 3 weeks, 3 months, 3 years, or longer out?
Right. Yeah, so we've actually back-tested this portfolio all the way back 20 years. So we have a pretty good sense of that it can perform in all weather positions. Remember, if you go back to 2002 to 2007, interest rates were rising in that period too. So what we're going through today is quite similar to that, with possibly a more robust outcome. If anything, the period of sort of growth constantly outperforming would suggest, hey, maybe this value metric doesn't work. But in fact, when you combine momentum, value, volatility, and profitability across all time periods, you do tend to find that that combination does very well. In any form of interest rate regime, in any form of inflation regime, these factors tend, as a multi-factor family, to outperform the index.
Gina, as you talk to clients, as you talk to people who are trying to figure out how to be more specific with the stocks and the sectors that they pick, how much do you get a sense of a wholesale move away from broad indexes?
I think this is a great question, Lisa. It's something I was actually discussing yesterday with our ETF, head of ETF analysis, Eric Balchunas, because I think going forward, investors are really going to struggle with index investing. The primary case for index investing, of course, over the last several decades has been lower and lower cost. But with the evolution of packaged products across the space, we have lower cost for a multitude of products. Going into an environment where indices may be somewhat long-term range-bound because of the dynamics of growth, inflation, and interest rates really changing, your index returns may be somewhat suppressed. But that doesn't mean that you can't outperform by owning equities. But you have to go much deeper into the indices. You have to focus on sector selection, stock selection. Significantly greater active management tends to perform better. Let's think about the period of time, say the 1968 to 1982, broadly considered a bear market in stocks. The inflation dynamic was significantly different. Interest rates were much higher. The U.S. economy generally continued to grow, but inflation was much faster. Policy was really difficult to contend with for equities. So, nonetheless, you did still see periods of equities outperforming. You just had to actively manage portfolios. And I worry we're going into something similar over the next 10 years, which may make index investing really take a back seat to more active management.
You worry, Gina. You said worry. And I think that this is an interesting comment. To go philosophical Wednesday, how much does this really change the landscape for companies that have benefited from being included in indexes that might not just get a knee-jerk allocation in the same kind of way? How much does this transform valuations in the way that you really see what the actual fair value really should be?
I think what it does, frankly, Lisa, is really benefit some of the smaller companies' lower duration stocks relative to the high duration, high growth sort of profile that has really dominated performance for much of the last decade. Inflation theme, it fits very well with a high interest rate theme, but it also fits with sort of an index, a decline of index investing kind of environment where the smaller companies tend to perform a little bit better, where you have much greater active management, where your selection makes a big difference. So I do think that what you see is that we've already seen this over the course of the last year. The market cap skew of the index is already in the process of changing. You've had magnificent outperformance for energy stocks, for instance, even though the S&P 500 at large is down. So you've got winners and losers as opposed to all winners and the big getting bigger.
Let's go to Cheerios. You're long Cheerios in your portfolio, Gina Martin Adams, with General Mills. Mediocre dividend growth. Granted, it's done better recently as well. Are you buying value like Cheerios? Are you buying growthiness within the MVP portfolio?
Yeah, it's all value. So when we think about the factors that select for selection,
why are you against growth? What is wrong with growth? What's wrong with growth?
Well, growth in the form of profitability, I think, is important to consider. Growth is a really broad term, Tom, so we have to be really careful as to what we're talking about when we talk about growth. I think profitability is a very strong factor for performance, has worked very well over the course of this last year even. And to the extent you focus on profitability at a reasonable price with value, low volatility, and momentum, you can do very, very well. But growth for the sake of growth, focusing exclusively on the top line revenue growth, it just doesn't work in an environment like today. And the portfolio is structured accordingly. So I think you have to be very careful about thinking about growth for what? What kind of growth are we looking at? What's the cost of that growth? Does it result in profitability? Because that really is the key. Growth for the sake of growth just doesn't work in an environment like the one we're in right now.
Gina Martin Adams, thank you so much. She back tested the triple leveraged all cash fund, and that boom year, she fell off her chair. She was laughing so hard. With the Bloomberg Intelligence MVP portfolio, we're going to be watching this through 2023. What we're watching today, Lisa, it's a modest moment at the Brookings Institution here before the 2 o'clock World Cup meeting. Do you think he's going to speak for 8 minutes? Like, remember Jackson Hole?
Yeah.
Where they're freezing and we're like this. Oh, good, we can go inside. And they go, he stopped speaking.
Yeah, he began and then he stopped. And when he was speaking, he was repeating the same thing over and over again. We're going to raise rates. It's going to be painful, and we're going to keep him there. And he's going to repeat that today. How much does the market get his message? If he says, we're seeing strength that you're not seeing, if he lays out what the response mechanism will be and what it will take for them to cut, perhaps that'll have an impact.
Thank you to our guest today. It's really interesting here. The final day of November, we launch into December. That means the economic data as we go to Jobs Day on Friday. Please stay with us as we parse that through. Much more to talk about through the morning, to the Powell conversation of the 1 o'clock hour this afternoon. On radio, on television, this is Bloomberg Surveillance.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
Chairman Powell just around the corner, live from New York City this morning. Good morning, good morning. Equity futures slightly negative on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, setting the stage for December and beyond.
We're obviously waiting for Powell.
The most important piece of Fed speak.
What will he say here?
50 basis points is very well telegraphed and priced in.
We've gone from pause.
There's going to be a lot of data.
To pivot.
People are looking for the pivot.
To slowdown.
I think there is a slowdown coming through.
To any type of good dovish rhetoric, and it's just not there.
For me, it's not the quantum of rate hikes. It's the higher for longer narrative where I think the tail risk lies.
We are going to stay above 5% through 2023, and that's not what the market's pricing in.
I'm not sure he's going to be totally super impressed by the recent rally.
You have a disconnect, which is dangerous.
I do think we're in for a period of choppiness.
This recovery isn't going to be easy until we see some progress.
Risks to the economy going forward from over-tightening.
Market participants will certainly be focused on that.
Joining us now to discuss is Morgan Stanley's Matt Hornback, James Athey of Aberdeen. Matt, first to you, buddy. What are you expecting from the chairman a little bit later?
Hey, John, thanks for having me on. I think we're going to hear more of the same from Powell's last performance in November. I think it's a pretty clear message. The Fed still has more work to do. They've got a couple more rate hikes at least in the pipeline. They're going to stay in restrictive territory for as long as it takes to help inflation come down to 2%. And they don't have to keep rates there forever, of course. They're not going to wait at 5% or above until you get all the way back to 2%, but they're going to be there for some time.
James, are you expecting a repeat of the last Fed meeting?
Yeah, I don't really think there's anything new for JP to say at this stage, to be honest. Of course, he doesn't want risk markets to get carried away. He doesn't want financial conditions to ease dramatically at this stage. I think that the bounce in equities will have been a pretty minor concern for the Fed, but it will have been a concern. He'll want to try and prevent that running too much further, but you know, the cat is out of the bag. 50 basis points rather than 75 is becoming the standard, and beyond that, you know, realistically, I care a little bit less about what the Fed thinks today they will be doing in a few months' time. I think the data is increasingly going to be in the driving seat in that regard. If we see soft jobs data in particular, I think that increasingly is likely to stay the Fed's hand a little.
I think this is the question of the moment. Lisa asked it earlier this week on Bloomberg Surveillance. Matt Hornback, what's more important this week, the Fed speak or the data?
John, I think the data for sure. I agree completely with James. I care less about Powell saying the same thing that he said a month ago at this point in time. I care much more about what he's going to say early next year, depending on how the data comes in. If we get what our economists are looking for, 180,000 payroll job gains on Friday, that is going to keep the notion that monetary policy lags are the right way of thinking about things at this point. The data will continue to weaken. So we're at 180,000 on Friday. That's slightly below consensus, but very much below the whisper numbers.
James, are you looking for something in and around 200K as well?
Crikey, I'll leave that game to the economists. I think at the best of times it's a bit of a random number generator. I've been surprised by how robust the labour market has been to this point. I think just scratching beneath the surface of ADP today, beyond leisure and hospitality, the service sector did look weak, and I think that's been the key part of this story is this sort of rotation from goods demand to services demand post lockdowns, and services is clearly a more labour intensive side of the economy. And I think once we see that begin to soften, as I expect we will, I think that will become the main narrative, and there's some tentative signs from ADP today that we may be seeing that.
More data still to come. JOLTS data, job openings in America coming up a little bit later. Mike McKee's going to be breaking all of this down for you. Let's get to Mike right now. Morning, Mike.
Good morning, John. Well, you're talking about labor market issues and the Federal Reserve. That's the topic of Jay Powell's speech today, is the labor market. We'll see what he has to say. The idea that we may be seeing a weakening comes in the ADP report numbers today, only 127,000 jobs But here's the comparison of ADP to non-farm payrolls for private sector jobs, apples to apples. And the red line there is where ADP changed its methodology. Not sure it makes a whole lot of difference, but the one thing you can see month after month is that ADP has underestimated what comes in from the non-farm payrolls numbers. So it's going to be interesting to see what happens on Friday and if we get the kind of fall back off that we thought. Before that, though, we still have JOLTS, and JOLTS is, it's never been important to the markets, but it's become important to the Fed because Jay Powell cites the white line there as a reason why the economy it still needs more restriction because we have a lot of job openings. So that number is something that the Fed is going to be looking for to come down. And we'll see, since we get this number now, and Powell will know it when he gets up on stage, whether he references this, whether it influences what he says or not. But I think the bottom line that both of you were talking about, that Matt and James were talking about as well, is that the Fed is going to be looking at what the markets are doing right now. And you can see financial conditions have started to ease after the Fed raised rates, and now the Fed is talking about going higher, but financial conditions are not. Whether that means it's harder for the Fed to get its job done or not, I think the point is the markets are not respecting what Jay Powell is saying. So he maybe want to go back to the Jackson Hole formula of being direct and telling people we are not going to be cutting rates anytime soon, sort of like John Williams did yesterday with a little more authority because it's the chair speaking.
Mike, great work as always. Mike McKee, thank you. Matt Hornback, I want to pick up on what Mike just said. I think it's really important. Are we paying less attention? Are we less sensitive to some of the Fed speak over the last month?
John, I don't think that's the case when you talk to investors. Investors that we speak with, and what you can see in the New York Fed survey of market participants is that investors broadly are on the same page as the message that Powell and his colleagues on the FOMC have been delivering, that the Fed is not going to be cutting rates in 2023. That is the expectation embedded into the psychology of investors. What you see in market prices incorporate risk premia, John, and this is a classic way of looking at market price. You know, we have about 50 basis points of rate cuts priced into the fourth quarter of 2023. Now, John, look, if I could tell you exactly what would happen in 1 year from now, well, gosh, I would probably be in James's seat, not in my seat. So, you know, I think the issue is we don't know, and markets have risk premiums, and that's what's going on here.
I think you and I would both be on the buy side, putting money to work. So let's put some money to work, James Athey. I want to understand what works in what kind of backdrop. So next year, let's go through the consensus view. And Michael Hartnett would kill me for calling him consensus, but this sounds pretty consensus to me over at Bank of America from Hartnett, the team this morning. They're basically long bonds in the first half of 23, long stocks in the second half, and they say we stay bearish risk assets in the first half, set to turn bullish in the second half as the narrative shifts from the inflation and rate shocks of 22 to recession and credit shocks in the first half of 23, then bullish peak inflation Fed US dollar in the second half of 23. Do you think, James, the long bond works in the downturn that people expect in 23?
Yes, I do. I don't think it is necessarily going to be the best place to be. You know, I totally agree with Matt. I mean, first and foremost, I am sat in this seat, Matthew, and I definitely don't have a clue what's going to happen in a year's time, for sure. But if we just look at market pricing for inflation says the headline rate of inflation is going to have a 3 handle by the middle of next year, and it's going to have a 2 handle by the end of next year. And consensus, broadly speaking, expects there to be some sort of recession. If we're in a world where the economy is in recession and inflation has fallen from 7/8 to 2/3 in a straight line, presuming that the labour market has weakened as you would expect in any sort of traditional recession, I don't think it's unreasonable to be thinking that the Fed might be easing back from tight policy to neutral policy, maybe slightly easy policy. And the long run dot is still somewhere around 2.5. If they assume they meet their inflation target in the long term, that means that could be 200 basis points of cuts. So I agree with Matt. At the moment, pricing incorporates a risk premium. We don't really know. Inflation outlook is highly uncertain. But if we take market pricing at its word, it's not unreasonable to not be too concerned about what the Fed is saying today about what might happen in a year's time. Let's be honest, once we know that communication is in and of itself a policy tool, it leads to this problem where we know they're saying these things because they need the market to react in a certain way today, not because they necessarily actually believe that's the future that we're headed for.
This is what they want to signal. Now, Matt Hellenbach, with all of that in mind, does the 10-year make sense right now for you at about 377?
I mean, John, like I think that the market had a big reaction in the wake of the last CPI report. Most investors that I speak with see that report as likely to be a one-off downside miss, similar to the one-off downside miss we had back during the summertime. So I think generally 375 on the 10-year would make sense given what's going on with inflation the present moment. But if the next CPI report surprises to the upside, I think what a lot of people are generally thinking, then you should see 10-year yields move a bit higher from here. But from my perspective, inflation has peaked in the United States. We think it will peak this quarter in Europe as well. That should put a cap on long-term interest rates. And I think generally we have seen the peak in long-term interest rates in developed bond markets.
So where is there scope for surprise? This is a question we've all got to ask as we get our hands around what the consensus view is in 2023. Deutsche Bank put this out this morning, guys. I think this is a good thought exercise for us all to go through. They said it's worth remembering that exactly a year ago today, markets were pricing a Fed funds rate of 0.68% by the end of 22 and CPI of 2.6%. Given the huge forecasting miss over the last 12 months, it's remarkable how settled the consensus is around a terminal of 5%. James, can you speak to that? Just where is there scope for surprise in either direction relative to what we're expecting into next year?
Yeah, I think that's a slightly unfair comparison. Of course, if you get the inflation outlook totally wrong, you're going to get the policy outlook totally wrong. And equally, if inflation, as Matthew's just sort of intimated there, right, the uncertainty around inflation is low, it could be that the recent CPI report, not just in the US, elsewhere, was a one-off. It could be that energy prices resume their rise, and we see headline inflation moving higher again. And so all bets are off at that stage. But when it comes to the actual sort of rate policy forecast, you have to take into account other considerations beyond just headline inflation. And the broader economy cannot cope with rates going from 5 to 6 to 7 to 8, even if inflation is sticky around 8%. And I think that's why markets have sort of settled on 5%-ish for now as being a reasonable best guess for the terminal rate. And again, considering that inflation forecasts start to fall. But where could there be surprises when it comes to inflation? And this is something I've said not just in this recent episode, but for many, many, many years. We really don't know. We don't understand the concept. We struggle to measure the concept, let's be honest. We see that from statistical changes that are made. And its sort of centrality in terms of the monetary policy framework, in my opinion, is somewhat concerning given how poorly we have macro and micro models to understand it.
Matt Hornback, final word, sir.
I think the biggest scope for surprise goes back to something James said earlier, that central banks' communication could change dramatically if, in fact, inflation comes down like markets are pricing and economists broadly are forecasting. You know, the Fed has already set the scene for a change in their communication next year by starting to focus more on the lags with which monetary policy operate. If you're talking about PCE inflation, either core or headline, somewhere between 2 and 3% by the time we get to the third quarter, all of a sudden the lags with which monetary policy operate threaten to take inflation below your target, which, John, is a problem that the central bankers do not want to get back into. That's a problem they spent 20 years trying to get out of unsuccessfully until the pandemic.
Matt Hornback, James Athey, sticking with us. Coming up on this program, China sending a warning to protesters.
We believe the Chinese people have a right to protest peacefully. They have a right to make their views known. They have a right to be heard.
That conversation up next.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We believe the Chinese people have a right to protest peacefully. They have a right to make their views known. They have a right to be heard. It's obviously a very important event for the people of China, and we're watching it, of course, with great care and great attention.
The United States suggesting China should not interfere with protests. China seeming to push back. The country's top law enforcement body pledging to crack down on what they called hostile forces and their, quote, sabotage. All this amid a record COVID outbreak and further contraction in China's economic activity in November. Team coverage starts right now with Bloomberg's Tom McKenzie in London and Katie Lyons here in New York. Tom, first to you. What's the latest?
Two key things that have come out of Beijing, out of China, just in the last 24 hours or so, John. One is a softening of the language around COVID-0 in the state media and from officials, seemingly to soften up the public for maybe an easing of restrictions. Minimal, they're not moving away from COVID-0, but maybe some easing of restrictions. And we've seen, in fact, in some jurisdictions, for example, around where that Foxconn factory is in central China, of course, producing those iPhone 14s, some movement there to move the dial in terms of cutting back on some of those rigid rules. Transport, for example, has stepped up in some cities as well. On the other hand, as you mentioned, the state security authorities and the state security apparatus stepping up. So you had the former chief spy of China, now involved in ensuring there is security across the nation, saying and blaming hostile forces. This is a line they ruled out back in 2019 during the protests of Hong Kong, so seemingly nodding to foreign forces there. Hostile forces they blamed for this unrest, and we should expect a clampdown, possibly the targeting of some deemed to be ringleaders in these protests. We've seen police, for example, checking people's phones. So on the one side, clamping down on the security front, on the other side, seemingly on the edges, on the margins at least, softening around COVID-0, not walking back from it.
Katie, a softening of the language, a softening of the data as well.
Yeah, a real softening in the economic data because of COVID-0 policy. When you look at the PMI numbers for the month of November, they contracted even further than was expected. The manufacturing print coming in at 48, that was below economist expectations of 49, and of course is in contraction territory, which is denoted by that 50 line. You also had a lower than average estimate non-manufacturing index. That declined to 46.7 from 48.7 in October. And COVID-0 policy and restrictions surrounding it, definitely a large factor in that. Remember, Nomura recently estimated that about a quarter of China's total GDP is affected by lockdowns. But maybe there is some good news. Tom outlining some of that in the marginal relaxation of restrictions, but also after a record outbreak, the case count is starting to ease back a little bit. The line is heading back in a downward direction, and that is lending support to the idea that China is heading at least on a path toward reopening, and that has given a big boost to Chinese assets over the month of November. These moves have been remarkable. The Chinese yuan strengthening against the dollar today, even despite the weaker data, and on the month stronger by 3.5% to the 707 level. This was the best month for the offshore yuan on record. And then when it comes to the equity market, the CSI 300 with a gain of about 10% had its best month since July 2020, and the Hang Seng with a 27% rally had its best month since October of 1998. We have to keep in mind the context, though, even with a rally like that in November, that index remains down 20% on the year, John.
That move in a Hang Seng is ridiculous. Katie Lyons, thank you, alongside Tom McKenzie. Tom, thank you, buddy, over in London. Back with us for a final thought, Matt Hornback, James Athey. Matt, first to you. As you put together your outlook for 2023, where does China and the reopening theme fit in?
It plays a critical role in how we think about commodity markets in 2023. It also plays a critical role in how we think about the broader U.S. dollar. We have been ahead of the game here in terms of calling for China to reopen. Our chief China economist, Robin Jing, has been all over this, calling for an earlier reopening, a bumpy reopening to be sure, but certainly a reopening. And that plays into our commodity price forecast, certainly in the energy market, where we think energy prices are likely to rebound. And then that also contributes to our outlook for the dollar to have peaked this year and for the dollar to head lower next year as global growth expectations rebound alongside that reopening in China, John.
So, Matt, euro dollar 103, cable 120, dollar China doing its thing. Katie just went through those numbers. Matt, where are you pushing that view through right now in foreign exchange?
Well, certainly euro dollar higher. We're looking for 108 in the near, kind of in the next 3 to 6 months. That's a key driver, but also in the emerging market space, John. We think there's plenty of opportunity to be short the dollar against some emerging market currencies, particularly in China.
James Athey, are you on board with that?
In the end, yes. You know, this starting point, and as we move through the end of the cycle, the dollar down trade, I think, is going to be a huge one. We're a bit more circumspect near term. We believe that the dollar's got one last leg to this rally because, essentially, for the view that you laid out from Michael Hartner, we still don't think risk assets are in any way, shape or form pricing the coming developed market recession. And we think this last leg down in risk assets is going to give us a bid for the dollar, as we tend to traditionally see. Obviously, once we start thinking about Fed cuts or even pricing Fed cuts properly, we may well find then that the dollar has peaked out. Whether that's a peak higher than the last few months or not is difficult to say, but we don't think the dollar is done just yet. On China, of course, the reopening story is going to be really significant. We see that for markets. Yep. Underneath all of that, China still has some huge growth challenges. They still have very different strategic priorities today to ones we've become accustomed to in the recent past. We don't think China is going to be a source of booming growth anytime soon, even if they do go to a full reopening.
You mentioned Hartner, B of A. The core call of the team at Bank of America right now is recession in the United States next year, recession in the Eurozone, recession in the UK. Matt, is China reopening sufficient to engineer that dollar weakness that you're anticipating, given we may have recession in the US, in the Eurozone?
Certainly, John, and I think ultimately the dollar going down next year is going to solve a lot of the world's problems, particularly when it comes to inflation outside of the United States. We have to remember the U.S. is a large, relatively closed economy. There are lots of economies that are smaller and more open. And so if the dollar is going down against those currencies, then that will help inflation in those areas come down as well. So the dollar going down on the back of inflation here coming down, on the back of pricing in more Fed rate cuts, as James and I discussed earlier, that's going to help solve a lot of problems next year, John.
On course, potentially, for its worst month since 2010 on the dollar index. Matt, wonderful work as always, sir. Matt Hornback there alongside James Athey. We'll try and catch up with both of you before year-end, no doubt. A couple of headlines just coming through after the Thanksgiving weekend. This from Amazon. Thanksgiving holiday shopping weekend was what they're calling the biggest ever. We'll pick up on that theme around the opening bell. This headline as well from Treasury Secretary Janet Yellen. Much speculation about her future in the administration. She's speaking at a New York Times event here in New York City. She's saying that she plans to stay in her role as the Treasury Secretary. That headline dropping just moments ago. Coming up on this programme, the morning calls in later. Bowersock's Emily Hill expecting a rough start for equity markets next year. That conversation just around the corner.
of the satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
Just a little bit more than 4 minutes away from the opening bell. Equity futures unchanged on the S&P, just about positive on the Nasdaq, up 0.2%. That's the price action. Here's some morning calls for you. First of all, from Morgan Stanley, adding Blackstone to its financials finest list, highlighting the stock's compelling valuation and attractive risk reward. Your second call from Stifel, downgrading CrowdStrike to hold after quarterly results, expecting clients to pull back on spending due to lingering macro headwinds. That stock is down by more than 18%. And finally, B of A, Bank of America, downgrading Carvana to neutral, citing concerns about the company's cash burn and liquidity. That stock is down by more than 3%. Coming up, the calls for caution keep mounting. Bowersock's Emily Hill warning that recent gains are just a bear market rally. That conversation up next, your opening bell, just around the corner.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
When innovation strikes, Bloomberg technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
24 seconds away from the opening bow this morning. Good morning to you all. Coming up a little bit later, Chairman Powell, 1:30 Eastern Time. A little bit later this morning, about 30 minutes from now, job openings in America. Going into all of that. Equity futures unchanged on the S&P. On the Nasdaq, basically unchanged as well, up by just 1/10 of 1%. On a Russell, up by 1/10 of 1% too. There's the opening bow. Switch on the board and get to the bond market. Yields on 10-year Treasury shaping up as follows. On a 10-year high by about 3 basis points. Up on the session, down on the month. On the month, we're down about 30 basis points or so on a 10-year yield. That's driven the inversion, a deeper inversion into the yield curve, 2s versus 10s. In the FX market, what a run we've seen on euro-dollar so far this month. Euro-dollar on the month advancing. The dollar index is down about 4% and some on the month and potentially heading for its worst month since 2010. Abby's going to dig into all of that in just a moment. Crude right now up 3.4%, reclaiming an 80 handle on WTI, $80 and about 89 cents. Wrapping up the month of November then is Abby.
Yeah, John, what an interesting month. It's hard to know where to go. Oil plunging, copper soaring, Bitcoin crashing. But at the end of the day, I would argue the most simple story is the best story to start on, and that is stocks up, dollar down. Now, we this year have been talking so much about yields down, stocks up, but yields are actually mixed on the month. That 10-year yield down sharply, as you were mentioning. The 2-year yield actually up slightly, but the Bloomberg Dollar Index down 4.5%, heading to its worst month potentially since 2009. The S&P 500 up 2.3%. In October, stocks were up, yields were up. So I would say that the continuous factor here for stocks up over the last 2 months, dollar down. As for the big movers, it's not your Apples, your Teslas, or even your Amazons on that great holiday quarter. It is all about China. NVIDIA up 16%, chips overall up 12%, having to do with the possible reopening, a positive meeting, of course, between President Biden and Xi. Bilibili, Pinduoduo, look at those moves, up 87% in a month. Pinduoduo up 46%. Great quarters there. Wynn Resorts, the Macau opening, one of the top stocks for the S&P 500. Speaking of the S&P 500, John, it's doing something that it has not done this year, which is 2 up months in a row. There are so many folks talking about this being a bear market rally. This here could potentially be the start of a trend change. We don't know that, but it's worth keeping a note. And it wasn't just stocks that did great in November. It was also bonds. Global stocks in the month of November up 6%, bonds up 5%, the best month since 2008. That means the traditional 60-40 portfolio, John, having its best month since November of 2020. November overall in 2022, not so shabby.
The everything rally, I think maybe we can call it. Abby, great work as always. About 2 minutes into the session, equities on the S&P up by almost 1/10 of 1%, on the Nasdaq up by 0.15%. On the S&P this month, biggest laggard, Apple. China disruptions fueling supply concerns. Tim Cook heading to DC to meet with lawmakers. A lot going on with this company. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, John. We're down 0.1% on Apple, but a 4th straight day of declines, its worst run in more than 3 weeks. And as we know, it has been a laggard this month, on track for its 8th monthly decline of more than 12% in the month of November. As you said, Cook has scheduled meetings with Republican representatives Jim Jordan of Ohio, Darrell Issa of California, and Kathy McMorris Rogers of Washington. Important because these are all key names likely to chair top committees that oversee tech when the GOP takes the House on January 3rd. Apple, interesting, trailing the S&P 500 year-to-date, but an outperformer relative to its mega-cap peers despite that recent pressure. It's interesting that the stock still has 37 buys, 8 holds, and just a sell. Really, the focus is still iPhone 14 Pro production in Zhengzhou. The news overnight is that authorities in Zhengzhou have eased long-standing COVID restrictions that have been in place for around a week. However, they have issued a new list of key districts and buildings that will be subject to pretty tight controls. And we're trying to make sense of what this means for iPhone production in the key last 3-month period of the year. Bloomberg Intelligence out overnight with a report or a deck saying that The supply chain issues in China are not fully reflected in Apple's fiscal first quarter 23 sales consensus. They think that that sales consensus should be revised down 3 to 4 percentage points. I think actually there may be a little way to go with this stock, John, because people are still trying to feel out the material impact to the top and bottom line from what we're seeing in China.
And I've enjoyed the show with you and Caroline over the last couple of weeks. Can you just tell me what you've been discussing around the Apple situation with Twitter? And if you can go a step further, how that's playing out down in Washington, D.C. and maybe beyond.
Yeah, I think, you know, the reality is that Musk has a ginormous following, irrespective of his ownership of Twitter. The conversation in recent days on Bloomberg Technology has been, well, actually, what he's been saying about Apple, particularly the App Store, is a conversation that's been going on, right? Epic Games, Spotify have taken this battle with Apple to the courts. So Musk has some sympathy on that standpoint. Many others are shocked that Elon Musk would pick a fight with the world's biggest technology company and Tim Cook in particular. And I think that news overnight about Cook organizing meetings, which may have been in place for a number of weeks now, but they're going to their playbook of talking to DC, the power or the center of power at any given moment, and making sure that Apple gets its point across as well. I think that's fascinating, John.
Ed, great work as always, mate. Looking forward to the coverage a little bit later. Your equity market right now positive 0.2%, 5 minutes into the session, of 0.4% on the Nasdaq. Emily Hill of Bowersock Capital joining the calls to fade the recent rally, saying the following: it should not be a surprise that higher interest rates, a strong dollar and rising labor costs take time to show an impact on earnings. The next reporting season will deflate this rally. Emily Hill joins us right now. Emily, where do you think that earnings risk is concentrated in early next year?
Well, I think we may have seen a lot of the earnings risk come through in the tech sector. But, you know, one of the things that's been a surprise to watch is the rally in industrials this year. And, you know, I remember last summer talking to you about Honeywell and our optimism about that company. You know, John Deere, Caterpillar, Honeywell, all the industrials rallying, which is not typically indicative of a recession. But I think we have not seen, you know, in some of those more traditional cyclical sectors, the impact of these higher rates. And that's where I expect to see earnings struggle in that fourth quarter reporting season.
So Honeywell, relatively speaking, outperforming in a massive way this year. Year to date, up by about 3-4 percentage points. Emily, is that the part of the market you'd fade the most then? What's happened with the industrials?
Is that the part of the market that I'd
you would fade, given the rally we've seen?
Fade. Yes, I would be taking some profits in healthcare, industrials, you know, the parts of the market that really haven't seen the impact of inflation, higher interest rates, et cetera. So we may have actually seen, you know, I don't think it's time yet to buy tech and the typical, you know, consumer discretionary stocks, certainly. But most of the air has come out of there, or at least some of the air has come out of that bubble.
So, Emily, where would you hide going into the mess you expect in early 23?
Well, as I've said before, and I should also say, you know, one of the things about our expectation for first quarter and second quarter of 2023 is that there really is a consensus out there that this is a bear market rally, you know, and that we're expecting a mild recession. And I am positive that this is a bear market rally, which gives me pause, because if I'm ever positive of anything, it's you know, I'm likely to be wrong. So where would you hide? You know, we have diversified portfolios. We really like the short end of the curve in bonds. You've actually seen money, you know, treasury or T-bills at over 4%. We think there are good discounts in small cap stocks where we have a bigger discount against large cap U.S. stocks than we've seen since the early 2000s. You know, most of these strategies will take a while to play out. We also like international developed market stocks as long as they are dollar hedged, because I do think that this recent decline in the dollar will meet some resistance, and I don't expect it to break through that.
Can we talk about tech as well? On discount, on sale, Amazon down 45% this year. Facebook coming into today down 67, Microsoft down 28, Apple down by more than 20%. Emily, what do you say to those people looking at those names with those moves this year, thinking, you know what, I might want to buy that, given what's happened over the last 5 years when we've had kind of drawdowns in those kind of names. They rip off the bottom. Why wouldn't you do that now?
Well, first of all, let's take Facebook out of it. You know, I don't know what Mark Zuckerberg is doing, but that's a totally different animal. So no, I think we need more information about what he's doing with the metaverse before you decide that that's a really good long-term hold. But the other names, yes, I think I think now is a good time to be buying some of these high-quality names that are still going to be around, decades from now. And I would put Microsoft and Apple and Google, I would put all of those names into that category. Just don't expect to make a lot of money on them in the short term. But overall, yes, this is a good time to build positions in some of these oversold tech names. I don't see them as, dramatically undervalued by any means. But for the first time, they're closer in a long time, they're closer to fairly valued. So, yes.
They've been battered, that's for sure, through 2022. Yeah. Emily Hill, wonderful to hear your thoughts on this market. Emily Hill of Barasot Capital, just another voice who thinks this is a bear market rally, looking for pain in earnings season when it kicks off in Q1 23. Amazon with some news a little bit earlier this morning, looking ahead to get ahead of rate volatility, raising over $8 billion in a 5-part bond offer. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Yeah, Amazon seemingly seizing a window of opportunity here with the second bond offering of 2022. As you said, $8.25 billion, 5 parts. The longest duration is 10 years, and that, according to people familiar with the matter, is going to yield about 95 basis points over treasuries. And interestingly, this offer size initially discussed was about $7 billion, so it turned out even larger, which indicates a certain degree of big investor demand. What is Amazon going to use this money for? It could be used to repay debt as well as fund acquisitions and share buybacks, but this seems more like borrowing because they can, not because they need to, because Amazon has tens of billions of dollars in cash, and our analysts here at Bloomberg Intelligence say, given that cash amount, funding isn't needed. It just provides incremental funding power. And a number of other companies are looking for firepower as well. The Amazon deal was one of 11 investment-grade offerings yesterday, and Bloomberg's informal survey of underwriters this morning indicates another 5 may come today. So they may be looking to take advantage of the fact that spreads have come in. IG spreads are currently around, 130 basis points, which is more than 30 basis points below this year's peak of 165, and the cost of issuing debt has also fallen since the high it reached in October. It now sits at about 5.36%. So maybe it all comes down to timing. And on that note, I would just point out that when you look at U.S. corporate bonds, the largest clump of them mature in 2025, and about $1.8 trillion worth will mature between now and the end of that year. And with unknowns about what rates and spreads are going to look like and concerns around an economic slowdown, companies may be looking forward at uncertainty and deciding to act now, John.
Kaylee Lyons, thank you. About 11 or 12 minutes into the session, the S&P is basically unchanged, on the Nasdaq up by 1/3%. Coming up on this program, lawmakers rushing to avoid a rail shutdown.
I don't like going against the ability of unions to strike, but weighing the equities, we must avoid a strike. We could lose 750,000 jobs. That must be avoided.
That conversation up next.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business,
The challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How do Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
We must avoid a strike. Jobs will be lost, water will not be safe, product will not be going to market. We could lose 750,000 jobs, some of them union jobs. That must be avoided.
This was something that was celebrated by this administration, that it was fixed. And now, right before a holiday season, we have to rush something to the floor.
We're going to try to solve this ASAP.
All hands on deck in Washington as Congress seeks to avoid a rail strike. A House vote underway to implement the tentative deal reached back in September. Amid oppositions from lawmakers, Republican Senator Marco Rubio writing in a statement, just because Congress has the authority to impose a heavy-handed solution does not mean we should. It is wrong for the Biden administration to ask Congress to impose a deal the workers themselves have rejected. I will not vote for any deal that does not have the support of the rail workers. AMH joins us now down in Washington. How tense is this one getting, Anne-Marie, where you are?
Well, it is a very tense moment, and it's a tricky one for the Biden administration because not only did the president intervene personally to try to get a deal done in September, but we do not have the votes out of 4 of those 12 of those labor unions, and it comes down to sick leave. And what you're going to see, Jonathan, is that the House is going to take this up to implement this tentative agreement to make sure that they avoid a rail strike. But Speaker Pelosi says that she is going to vote for sick leave. This would be a technical correction to that legislation. Then it goes to the Senate. And while you do hear from the likes of Senator Rubio, you also hear from Senator Sanders, individuals who are saying they are not going to vote for it if the workers' demands are not in it. And it's the fact that the workers are the ones that did not sign up for it. You do have Senator Thune, number 2 senator on the GOP, saying to Bloomberg News just yesterday that a significant number of the Republicans will vote for this because the Republicans and the Democrats on both sides, even if the fringes don't agree, understand the devastation this can cost the economy. And we're hearing from that already this morning from Treasury Secretary Yellen, talking about the disruption, the significant disruptions this would cause the economy as she's speaking at the Deal Book Summit.
It's all go after the midterms. We thought maybe there'd be a rejig of the cabinet, maybe a rejig of the Treasury Secretary and that seat. AMH, it sounds like Treasury Secretary Janet Yellen's going to be sticking around.
Yeah, it does sound like she's going to be sticking around, Jonathan. I mean, there's lots of always reports about potentially how there's going to be a shakeup in the administration, especially when it comes after midterms. But one thing that it's important to remember is that there wasn't this red wave in the midterm elections, which also maybe would have given the White House a little bit more oomph to say we're going to be shifting individuals around. At this point, they can maybe keep a lot of people in these same positions. A lot of people may want to stay in these same positions because there wasn't this quote unquote red wave. And actually the Democrats were able to hold the Senate, pick up a seat, and really only lost the House by a very slim number.
Is it your sense, Anne-Marie, that the railroad issues they're dealing with right now could just be the start of something much bigger? I'm thinking of the negotiations that have dominated much of the year, back end of the year, with the West Coast dock workers over in LA. Are we going to see much more of this?
Well, it does seem like in this moment in time in the economy, whether or not it's the labor unions or businesses as well, you do see employees feeling like they have more, they can make more demands to their employers. We are definitely seeing that with labor unions. Now, we should note that the majority of unions did vote for this tentative agreement. It's 4 of them that did not. And one of the biggest ones has to do with conductors. And this really comes down to sick leave. Potentially, you can see their demands being implemented in this tentative agreement. But you have a president who's also been leaning into labor demands. He has campaigned on the fact before he became president that he wants to be the most pro-labor union president we've had in modern times. This is why it is so tricky for him at the moment, because at this moment in time, the White House is leaning into protecting the economy instead of protecting what the labor unions say should be their right.
AMH, thank you. Anne-Marie down in D.C. We mentioned those comments from Secretary Yellen. Some other comments from Secretary Yellen in the last couple of moments as well. I misspoke on Musk and the Twitter deal in comments to CBS. I want to get back to Ed Ludlow on this on the West Coast. Ed, can you translate that headline for us?
Yeah, so Yellen speaking at an NYT event, and what she's saying is that the comments she made previously to CBS back earlier this month, end of October, about CFIUS or a potential CFIUS review, she was wrong. I misspoke on Musk and Twitter. She effectively said that at that time, the Treasury and other related parties as part of the CFIUS committee would not be looking at Musk and his purchase of Twitter based on their foreign ownership in the private entity. We've been looking into this, right? Because if you look at the cap table, which we don't have a full picture on, of the private Twitter, there are outside foreign investors that either rolled over their public shares or bought into the new private equity as part of Musk's take private deal, which closed October 28th.
Going to be more on that a little bit later, no doubt. Ed, thank you for breaking that down. Need to break down some economic data for you as well. At the top of the hour, we'll have JOLTS job openings. Mike McKee back with us for some data from a couple of minutes ago. Hey, Mike.
Hey, John. Well, it's raining in New York, it's raining in Washington, and I am your little dark cloud today in terms of economic data. The Chicago PMI is just out 37.2, a major drop in that index from 45.2 the month before. It is an index that is very heavily influenced by the auto industry because of the Chicago area's location. So we'll have to see what this ends up meaning, if anything, in terms of the labor market. Now, we did get the report today from ADP that showed 100,000 jobs lost in manufacturing. I'm not sure if I believe that. I know Neil Dutta was on with you and really thought that was a ridiculous idea. But take a look at, if we have this chart I sent along that shows all of the PMIs from all the regional feds have now come out for the month of November. Chicago PMI is not produced by the Fed there, but so it's on a little bit different scale. But all of them, except for the New York one, which is up maybe just a touch over the zero line, all of them showing contraction. So manufacturing contraction across the board, across the country, in all of these regional PMIs. It's not going to be good news for the economy, but it may be showing that the Fed and its tightening is starting to work.
Brutal. Mike, looking forward to your breakdown of the data coming up in about 7 minutes as well. Mike McKee there. For the broader equity market, we're down about 1/10% on the S&P with a sector price action. Here's Abby.
John, well, it's interesting that that bad news is not translating as good news right now, perhaps because it is so regional at this point. The S&P 500, as you mentioned, down slightly. Not a lot of drama sector-wise. Healthcare, the best sector, up 0.3%. Energy, tech right there, too. Financials, real estate are both down. But on the month, what a month it's been. And the overall message, basically, industrials and materials, those are the best sectors. And if we take a look at it a little bit more, chips also having a great sector, staples, durables. And then to the downside, it's all about tech, that Apple that you were talking about, and then speaking of autos, well, they're down on the month in a big way.
Abby, thank you. Up next on this program, your trading diary. What a couple of hours we've got coming up for you. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Minutes into the session, pretty muted price action here on the S&P, basically unchanged, slightly positive on the Nasdaq by 1/3%. That's the price action. Here's the trading diary. First up, top of the hour, Jolt's job openings coming up in about 4 minutes' time. President Biden speaking at 11:30 Eastern, followed by Fed Chair Jay Powell at 1:30 p.m. I'm hoping he wraps that up quickly. Argentina playing at 2 p.m. Eastern time. Jobless claims tomorrow morning. Then it's on to payrolls Friday. The estimate in our survey, 200K. From New York City. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team.